Options trading strategies. How to make money with the best and most effective strategies. Long-term passive income strategies for a job-free retirement. Written by Ned Jenkins. Published by Audiobook Nexus.
Options trading strategy. Introduction. By this point, you should have mastered all of the fundamentals and the most advanced trading strategies. It's finally time to delve into more advanced strategies. Before becoming a professional trader, you must first learn and understand several concepts. For example, you must comprehend the various options pricing models, why stock options behave as they do, volatility, and how it affects markets, measuring option sensitivity to underlying stock movements, and so on. These are critical topics if you want to trade successfully and earn a good passive income for a long time. These advanced strategies have not intimidated you. While they have a reputation for being difficult and time-consuming, you should be willing to put in the effort to learn as much as you can. You will quickly become a pro if you take your time and understand the concepts behind the various strategies and spreads. Furthermore, many options traders agree that these strategies and techniques are not overly complicated. Take the time to study. If you want to increase your income, you should learn about advanced options trading. Of course, there are definitions in terms and strategies, tools, and techniques. However, given how far you've come and how much you've learned over the months and years, you should do very well. With the knowledge gained from this book, you will be able to trade a wide range of instruments, including futures, forex, ETFs, binaries, and stocks. You will better understand how options behave and why they behave the way they do once you have this knowledge. You will be able to investigate the various market scenarios in this manner. Step-by-step instructions on how strategies work. You should also be familiar with both fundamental and technical analysis at this point. Some traders prefer one over the other, whereas others prefer both. After completing your comment, you'll decide which strategies to employ based on your findings. Advanced options trading strategies are similar to putting processes together to achieve specific goals. As a result, you should learn more about eliminating some strategies based on the results of your analysis. Flexibility. Advanced trading is more about the freedom and flexibility you have. When you enter a position, you can expect one of three things to happen: long, short, or neither. These three things are price movement upward or downward, price movement, no movement, or no movement at all. The difficulty here is that only one of the three possible movements will profit. Fortunately, advanced trading strategies allow you to profit regardless of market conditions. You will be guaranteed a profit if the price movement remains within a predetermined range. As a result, you will benefit if the price rises, profit if the price falls, and profit if there is no price movement at all. Freedom. We see a lot of freedom because advanced options strategies have a lot of flexibility. Unfortunately, many people fall into one of these two categories. They want to work hard and provide for their partners and loved ones. Unfortunately, most people must work, making it impossible for them to trade regularly. These people do not want to trade every day and monitor the markets every hour. If not minute by minute, it can be tiresome. This is where swing trading comes into play. You can become a swing trader place trades, and then go about your business for a few days. Trading advanced option. You already know how put and to call options are traded on the market and have enough experience to advance your knowledge. By this point, you should be ready to discover the incredible power of these options' flexibility and versatility via various advanced strategies. Strategies. Options strategies are trading methods that use options in various combinations to create market positions that allow traders to profit regardless of market conditions. When it comes to options, there are four major strategies. These options strategies include bearish, bullish, volatile, and neutral. Explosive strategies tend to profit when the market moves sharply in any direction or implied volatility rises. When there is no market movement, traders profit from neutral strategies. Bearish option strategies, for example, benefit traders when the market is trending downwards, whereas bullish strategies benefit traders when the market is trending upwards or rising. Spreads on option. All of the strategies mentioned above rely on spreading to function correctly. Option spreads are options positions taken in the market. These positions require the simultaneous purchase and sale of options contracts. Using option spreads is to create unique profiles with a desirable payoff. These are also referred to as risk graphs. All option strategies are derived from these payoff profiles. Understanding spreads and how they work, including the various mechanics, makes it simple to understand the different option strategies. Advanced options, trading terminology. You will need to learn more about the relevant terminology and definitions as you continue to educate yourself about advanced options trading. The terms listed below are some that you should become acquainted with. These terms will assist you in comprehending the mechanics of options and how they work. As a trader or investor, you should learn more about these terms and definitions. Spreads. A spread is an order placed by a trader to a broker with instructions to buy or sell two options simultaneously. The broker will then implement the instructions and place the orders via your preferred platform. Spreads can also refer to the process of hedging, or more specifically, the opening of a hedged position. For example, if you are bullish on an option, you will buy a bullish call spread option in the hopes that the option price will rise, and you will be able to sell it for a profit later. Hedging. Hedging is the process of offsetting, in whole or in part, the risks involved in investing in options, and thus holding a position. For example, you can buy a risky option and then sell another option to reduce your risk, even if it reduces your profit. Spreads are another name for hedged positions. Derivative. A derivative is an instrument, such as a stock whose price or value depends on the cost. It implies that the stock price derives from the price of another stock, share, or forex. Options, for example, are derivatives because their value is primarily determined by the underlying security's value or price. Cash. Settled. When a trader exercises an option, the option's value is transferred in cash from the seller to the owner rather than the shares. As a result, the option seller will transfer some money rather than shares. Equivalency. In options trading, this is a concept in which two different positions may be different in terms of price, but very similar in risk versus reward ratio. When the risk versus reward ratio is the same, this is referred to as equivalence. Inside the market, the actual bid, ask value for a single spread or option is referred to by this term. It is generally narrower than the market's published price. As a result, if you want to trade, you don't have to accept the offered prices and hope for the best. The National Best Bid and Offer abbreviates the National Best Bid and Offer. It really should be a beginner's term, but it isn't. Open interest is simply the total number of option spreads that are open and active but have yet to expire or be closed by market traders. Settlement risk. This is the risk of managing a position when you rely on the market's opening price. Settlement risk can also be defined as the profit lost or gained by agreeing to the settlement price as it is on the third Friday of each month, rather than as it is determined on Thursdays, as with European-style options. How are options priced? You must be aware of how options are priced. In most cases, the price of options will be made up of two parts. The intrinsic and extrinsic values are as follows. For example, we know that the inherent price is generally determined by the strike price's value concerning the underlying stock's value. As a result, it is also referred to as the money-ness of options. While we understand how intrinsic value is calculated, we don't know how extrinsic value is calculated. It is frequently a market factor and includes a measure of the risk taken by traders. So, how is this value calculated? When you sell options or buy stocks, various factors come into play. These variables are critical in determining the level of risk you are willing to accept. They include the total amount of money required to secure a position, the expected stock price movement within a given time frame, and various other factors. As a result, experts have been working to develop a suitable formula to work it out for a long time. This formula is designed to take into account all of these different factors. Today, a few mathematical models are in use that provides reasonable extrinsic value measures. The Black-Scholes model is the most well-known of these models. This model is regarded as one of the most dependable formula and the best pricing solutions. Furthermore, it has aided in developing a few more complex formulae that are also widely used. The Black-Scholes model focuses on 5 critical factors. The Greek alphabet is used to represent these 5 factors in the formula. They are gamma, which means the rate of change of sensitivity; delta, which represents the sensitivity to change in the value of the underlying security; vega, which represents volatility; and theta, which measures time decay. As a result, traders can calculate the theoretical value of stock options using the Black-Scholes model. Traders will easily compare this outcome to the actual value of options traded in the markets as a result. Furthermore, it allows you to determine whether market options are underpriced or overpriced. The ratio of reward to risk. Before placing an order as a serious options trader, you should calculate the risk to reward ratio. You will easily determine whether a particular trade is worth investing in this way. You will also be able to determine whether the businesses you wish to enter can meet your investment objectives. Cycles of option expiration. Some stocks and securities have options with varying expiration months, while others have longer or shorter expiration periods. Some stocks even have 2 sets of possibilities with the same expiration date. It is primarily because different expiration cycles are assigned to stock options. So, if you mix options with varying cycles of expiration, you'll end up with other stocks and underlying securities, all with different expiration dates. Options Greeks are terms that are frequently used in options trading. 5 different Greek symbols are used in the Black-Scholes model. Traders referred to these symbols collectively as the Greeks or options Greeks, or options Greeks, or options Greeks. Even though some in the options trading community question the Black-Scholes model's accuracy, it is widely used and widely accepted as a tool for determining the value of stock options. This model is the foundation of several popular options trading strategies used today. Delta-neutral trading options. Trading fundamentals have taught traders to profit from all market conditions, including upward and downward trends. So it is with the use of various options strategies for trading purposes. However, it is also possible to develop stock market positions unrelated to the underlying stock's price movement. These are commonly known as delta-neutral positions. Traders generally prefer delta-neutral positions in the market because they can correctly and precisely determine positions that will offset any price movement of the underlying security. These positions allow traders to profit from an increase in the implied volatility of the underlying security. Traders can also benefit from the general time decay of their positions. Finally, it implies that you can have a 100% winning position, which every trader desires. Volatility implied. The price of options is influenced by 2 factors more than any other. These are implied volatility and the value of the underlying stock. The implied security volatility significantly impacts an option's extrinsic value, whereas the underlying security price has a substantial impact on its intrinsic value. As a result, as the value of implied volatility rises, the option's price increases owing to increased extrinsic value. Demand has a significant impact on implied volatility. When there is a lot of interest in a stock or its associated options, implied volatility rises. However, IV or implied volatility opens the door to other profitable ventures. One of these is speculation. Mainly speculation on future volatility. When you buy stock options and the implied volatility is low, you will most likely make a good profit if the implied volatility rises quickly. This is true, even if the underlying security's price does not change. Another popular way to profit from implied volatility is to write stock options at high levels of implied volatility and then close these positions when implied volatility falls. Again, it demonstrates how vital implied volatility is in options trading, and understanding the concept is essential. Understanding leverage options. Options are sometimes used as a form of leverage by traders. In such cases, it is preferable to determine the power being used. It is significant because traders frequently over-leverage, which harms their trades. As a result, learning about options leveraging and applying it to trades will help avoid significant losses that would otherwise occur. It also helps prevent unpleasant surprises and gives traders adequate control, especially when it comes to the volatility of your portfolio. Makers of markets? Options traders frequently fail to consider who is selling the various options that they purchase. Some do, however, pause and wonder who could be losing all of the money that they continue to make. However, most traders are happy to make money and not lose it in the markets. There is a group of finance and investment specialists from major financial institutions. These investors are known as market makers because they are the ones who bring funds to the market. They are the ones you deal with, and they are the ones who keep the options markets liquid. Their presence in the markets ensures that you are always liquid and can buy and sell options whenever you want. When market makers enter the market, they place bids and buy all the available needs throughout the trading day. It means there will never be a time when you will be unable to purchase or sell options. Quotes at the second level. You are well aware that you must deal directly with market makers as a trader. These financial experts infuse funds into the market, making it liquid. In many cases, options traders would welcome information on which specific traders to deal with, even if it meant dealing with them directly. So it is even in cases where they stand to make as little as $0.10. It may appear to be a small sum, but it adds up, and the final figure can be pretty impressive. Level 2 quotes are those obtained directly from market makers by traders. At Level 2, you will be able to receive or view all of the various listed sections provided by individual market makers. If you are an options trader who prefers today trade, you will most likely be successful at Level II. These are ideal for options traders who want to make small but significant profits while trading quickly throughout the day. With options trade, you can create synthetic options. The flexibility of options trading is one of the reasons traders and investors prefer it over other forms of trading. You can, for example, convert your call and put options without even closing your hold positions. Furthermore, the ability to change or transform a short position into an extended position and vice versa allow traders to benefit from different market conditions and volatile and fast-changing market environments. It also assists in reducing commissions that you would otherwise have to pay. When a trader combines one option position with another or with some stocks to create different spreads options, this is referred to as synthetic positioning. Arbitrage of option. When trading options, you can generate profits risk free by using options arbitrage. When a trader uses particular option strategies to profit from price differences in options, this is called option arbitrage. Price differences occur, but they are scarce and occur only on rare occasions. When they occur, many traders rush into profit as soon as possible. When trading options arbitrage provides a consistent source of risk-free profits. Styles of option trading. Trading options on the market is a versatile strategy that allows traders to trade in various styles and methodologies. To be a successful options trader, you must first identify and choose a trading style compatible with your lifestyle and personality. It is critical if you want to be a successful trader. If you make mistakes and choose the wrong style, your trading exploits will suffer greatly, and you will not perform as well as you would have if you had chosen the correct manner. One of the main reasons most beginners fail is that they choose the incorrect trading styles. Understanding the various trading styles and selecting the best one for you is essential for successful trading. With the right trading style and proper investment education, you should do well and be a successful trader for many years. Leggings as an option. You will need to learn about legging as an advanced trader dealing with complex strategies. To begin, you should learn how to leg into a position. Second, legging is a vital trading skill that you should know. Finally, as a trader trading complex strategies with multiple leggings, you will occasionally need legging techniques to improve your results. When you leg into a position, you allow each component of your trading strategy to benefit from favorable pricing, which increases your profits. In some cases, profit margins may be so thin that legging may be the only way to boost profitability to meaningful levels during options trading. Assignment of options. As an options trader, you must understand that your options positions in the market can easily be assigned to others before expiration. This is especially true when placing credit spreads or writing options strategies. As long as the options have not expired, option assignment occurs automatically at any time. Chapter 1. Primary Strategies. A covered call is a financial transaction in which an investor selling call options holds an equivalent number of the underlying security. To accomplish this, the investor maintains a long position in either an asset or sells call options to generate revenue from the same acquisition. Throughout the investment, the investor's long position is cover, which means that if the buyer exercises the call option, the seller will deliver the shares. It is referred to as a buy right. Trade if the investor simultaneously purchases the stock and sells call options against this type of stock position. A covered call is a common option technique used to generate revenue in options premiums. Any trader who holds a long position in an asset sells call options on the same investment to conduct a covered call. Many people who want to keep the underlying asset for a long time are often optimistic, but they do not expect a significant price increase anytime soon. This strategy is ideal for an investor who believes the underlying price will not change significantly in the near term. Purchasing a naked call option is one method for dealing with calls. An introductory protected call or purchase right can also be set up. It is a common strategy because it increases sales while decreasing the likelihood that the stock alone will belong. The trade-off is that you must be able to sell your stocks even at a fixed price. To implement the strategy, you buy the underlying asset as usual and then write or sell a call option on individual shares, naked phone call. Experienced traders should only use this strategy. This strategy has an unlimited risk potential and an unlimited profit potential. As a result, this strategy is not suitable for novice or intermediate traders. In this strategy, you sell a call option on an asset you do not own. Because of this strategy is known as a naked call strategy because your position is highly exposed. For example, if you have a bullish market outlook and believe that the XYZ stock price will fall, you can sell a call option on that trade. You get to keep the premium you received for that stock. If the stock price falls, you keep the premium, your pure profit. However, if the price of those stocks begins to rise, which can happen at any time, the call buyer may choose to exercise the right to buy the supplies. In that case, you must purchase the shares at market value and sell them to the buyer at the strike price. Your loss will be the difference between the prices. Because the price of a stock can rise to any level, the profit potential in this strategy is limitless. Although monumental rises are uncommon in the stock market, they are possible in a significant event like a large merger or other important news. You will be forced to purchase the stocks at market value if this occurs. Your maximum potential will always be the highest premium you can obtain. However, the stakes are high. Although this does not happen very often, it is possible, so this strategy is not suitable for beginners or intermediate traders. It would be advantageous if you only use this strategy when you have a thorough understanding and experience with the market. Investors may use this strategy if they already have a short-term interest in the stocks and an unbiased opinion about their future direction. Furthermore, they may be attempting to generate revenue by selling the call premium or hedging against a potential drop in the underlying stock price. Covered calls are a well-balanced strategy, implying that the trader expects only a minor increase or decrease in the corresponding stock price over the term of a written call contract. This approach is frequently used when a trader has an unbiased short-term view of an asset and, for that purpose, keeps the asset long while having a short position through the option to earn money during the option premium time. Put, if an investor intends to hold the underlying asset for a long time and does not expect a significant price increase soon, they will generate revenue for their account while riding out the downturn. A covered call is a type of short-term hedging instrument for a long stock position. It allows investors to profit from writing the option by collecting the premium. Nonetheless, if the price rises above the option's strike price, the lender loses stock profits, the lender loses stock profits. If the buyer wishes to exercise the option at any time, they must provide 100 shares only at the strike price. The negative profit and loss from the call are balanced by the share's long position as the stock price rises in the profit and loss diagram above. Because the investor earns a premium from the sale of the call as the stock rises above the market price, the premium they make allows them to sell their shares at a higher level than the market price. The strike price, including the earned premium. The covered call's P&L graph is strikingly similar to a short, naked P&L graph. A covered call strategy is unsuitable for an overly optimistic or overly pessimistic investor. They are usually better off not selling the option and only holding the stock if an investor is excited. If the stock price rises, the choice limits the stock profit, reducing the trade's net profit. Similarly, if a trader is pessimistic, they would be better off selling the stock right away. If the stock falls, the premium collected for selling a call option will not cover the loss in the stock. The gross benefit of the covered call appears to be equal to the strike price of the short call option minus the selling price of the underlying stock, plus the premium paid. The maximum loss is similar to the selling price of the underlying stock minus the premium paid. The operator uses the blanketed acquisition strategy by writing a name alternative on the stock. It has already been purchased or acquired. With calls covered, the holder has access to the benefits of proudly owning the underlying asset up to the strike charge, in addition to income at the top rate in the sale. The stocks could be removed. The included call strategy has a plethora of unique applications. Some employ the strategy in order to profit from the knowledge, which may be feasible while markets remain surprisingly stable. It is a popular option strategy among traders because, in addition to the former, investors can profit from capital gains if the underlying asset increases in value. Money-buying transactions occur when the outlook is neutrally bullish. When should you use a covered call? The covered call method is typically available 30 to 60 days before expiration. It enables an operator to profit from the reduction in time. Of course, the best time to implement the method is determined by the buyer's objectives. If the goal is to sell calls and profit on shares, it's ideal if there isn't a significant difference between the stock price and the strike charge. If the goal is to promote the stock and the decision, you should be in a function where the calls will be assigned. For this to occur, the share price must remain above the strike price until maturity. Some investors promote and buy stocks at the same time. This strategy is known as purchase, promote, and it is used to lower the base price of newly acquired shares. There is no additional margin requirement in stock with hedging stocks while you have them. When promoting the stock, a suitable premium is 2% of the current price. The first foreign money for the stock fee. You must consider how you will benefit from the approach and set the top rate accordingly. If the volatility is high, investors will get a better top class when selling options. Many buyers want to keep stocks and then promote call alternatives at an excessive top class for this purpose in order to reduce the risk of losing a declining supply. Profit or loss. The maximum gain with this method is the difference between the strike fee and the current stock and the primary receipt from the call option settlement sale. Take note of the risks associated with this method. This method can result in significant capability loss. This loss occurs as the underlying asset's fee falls. However, the decline is slightly less painful than in stock trading due to the primary receipt for reducing the stock's downward motion. Break even. The break even point is the difference between the current price of the stock and the primary sale received from all alternatives. Example: consider the following example to learn how to recognize OTM calls. In May, a dealer purchases 100 shares of stock for $20 and writes a June 25 OTM name for $2. If the stock price is $28 when the options expire, the strike price of $25 is less than the stock price of $25 is less than the stock price. As a result, the call is assigned and the author sells the stocks at $25 per share. In this case, the dealer would have earned $5 from the stock movement and $2 from the calls for a total of $7. What if the stock fee had been reduced rather than raised? The author will lose the stocks in this example, but the calls will expire prematurely. If the trade becomes trading at 17, the dealer may have lost 3 in the room, but because he purchased calls for 2, his net loss is likely to be no more than married put strategy Vs. Protective put strategy. A married put is simply another name for the options trading strategy. An investor purchases an at-the-money put option on the same stock, maintaining a long position throughout the stock to hedge against price depreciation. The advantage is that even in the worst-case scenario, the investor will only lose a small amount of money on the stocks, but will still profit from price growth. The limitation is that a fee is charged for the put option, which is usually substantial. As a result, a married put is analogous to a covered call. This option strategy protects an investor from a sharp drop in the corresponding stock price. This strategy can be made prohibitively expensive by sacrificing the alternative. The cost of the put options varies according to the movement of the stock. The method could be effective for low volatility assets where traders are concerned about potential price changes. A married put works in the same way as an insurance policy for clients. When an investor is concerned about potential short-term risks in a stock, this is a constructive technique. Furthermore, by holding the stock with a protective put option, the investor gains stock ownership benefits such as dividends and voting rights. On the other hand, while owning a call option is just as beneficial as owning stocks, it does not provide the same benefits. Because the underlying stock's price growth is uncapped, Both a long call and a married put offer an infinite profit opportunity. However, profit is still significantly lower than it would be if only stocks were held, as the cost or premiums of the acquired put option are deducted. When the underlying stock increases by the sum of the premium charged options, the strategy reaches its break even point. The benefit is more significant than that amount. The advantage of a married put is that there is a base under the stock, which reduces downside risk. When the married put was purchased, the bottom is the difference between the value of the commodity stock and the price of the put. As an alternative, suppose the underlying stock was sold precisely at the strike price at the end of the option acquisition. In that case, the technique's loss is limited to the premium paid for the option. A married position is also known as a synthetic long call because it has a similar benefit profile. Because the same dynamic applies to restricted loss and infinite benefit potential, the method is identical to using a standard call option. The main difference between these methods is how much less capital is required to purchase a long call. The profit and loss graph above shows that losses are reduced as the share price falls with all long stock and long put positions combined. Nonetheless, the stock is eligible to participate in the appreciation that exceeds the premium paid for the put. A married put's P&L graph is identical to a long call's P&L graph. A married put strategy is more of an investment preservation strategy than a profit-making strategy. In fact, the value of the aspect of the plan implemented becomes a built-in price. The put price reduces the plan's viability by the option's cost, implying that the underlying stock will rise in value. As a result, traders should use a married put strategy as an insurance contract against short-term volatility in an otherwise favorable stock or as a defense against an unexpected price decline. Newer investors can benefit from understanding that their stock risks are low. It may give them more hope as they learn more about various investment strategies. Of course, this coverage comes at a cost, which includes the option price, fees, and possibly other fees. Debit spreads Vs, credit spreads. The following option strategies we'll look at involve unidirectional trading once more. The first strategy we'll look at is known as debit spreads. A debit spread can be formed by using either a pair of calls, which you would use if you expect the stock to rise in price, or a couple of puts, which you would use if you wish the stock to fall in price. These essentially serve the same purpose as trading calls and puts, but they offer risk-adjusted strategies. Then we'll look at credit spreads. Credit spreads are a completely different way of generating income than waiting for the stock to move in a specific direction. Put credit spreads, for example, can be used if the store is expected to remain above a certain level, while call credit spreads can be used if the stock is likely to stay below a certain level. Spreads on calls and debits. A call-debit spread is the first strategy we'll look at. In this case, you will simultaneously buy and sell a call option. As a result, they'll both have the same expiration date but different strike prices. Because one strike price is higher than another, the vertical spread is a vertical, with the different strike prices referring to the various strike prices. A call option with a price that is closer to the stock price is more valuable, and you will purchase it. You expect to profit from the lower strike price. You'd enter a call debit spread for the same reason you'd buy a call option. You expect the stock price to rise before the options expire. The higher strike price call's purpose is to mitigate losses. That call option will be sold by you. Selling a call option with a higher strike price reduces the cost of entering the position. It does, however, create a trade-off because it reduces the amount of profit you can make. A call debit spread, like an iron condor, is a low-risk, high-reward strategy. The likelihood of making a profit is increased while your total risk is reduced. However, Your earnings are also limited as opposed to simply trading call options, which have an unlimited profit potential in Nori. The maximum profit on a call-debit spread is calculated by subtracting the premium paid to enter the position from the difference between the two strike prices. A call-debit spread generates the most profit if the stock price rises to or above the higher strike price rises to or above the higher strike price. The distinction between this type of trade and simply purchasing a call is that your profit is fixed regardless of how high the share price rises above the higher strike price. The position's maximum loss is equal to the net premium paid to enter it. But first, let's look at some specific numbers to better understand the call-debit spread. Assume a stock is trading at $80 per share. We will make a call-debit spread by purchasing an $80 strike call option and selling an $84 strike call option. We'll assume there are 15 days until the expiration date. The call with a strike price of $80 will cost $123. We sell the call with the strike price of $84 for a $16 credit, bringing the cost of entering the position down to $107. As a result, the maximum profit per share is strike difference subtract by net cost to enter position equal to $4 subtract by $1.07 is equal to $2.93. Alternatively, our profit for 100 shares will be $293. The strike price of the call we purchase plus the net premium paid equals the break, even price for a call debit spread. In this case, $80 added to $1.07 is equals to $80. $1.07. Profits will gradually rise until we reach the $84 strike price, at which point we will profit the most. For any higher share price, the maximum profit remains fixed. Debit spread put. If you believe that the stock price will fall rather than rise, you can use a put-debit spread to mitigate the potential losses from investing in put options. It functions similarly to a call-debit spread, but with all of the possibilities switched to puts. A put-debit spread entails buying and selling a put option at the same time. We will purchase a put option with a specific strike price and then sell a lower strike price option. The net premium paid, which is the price paid for the higher strike price, is the maximum loss that can occur with this trade. Put less, the premium received as a credit for selling the put option with the lower strike price. The higher strike price less the net premium paid is the break-even point. If we have a stock that is trading at $100 per share and expect the price to fall, we can buy a put option with a strike price of $100 and sell a put option with a strike price of $95. A put option with a strike price of $100 will cost $1.25. A put option with a strike price of $95 will generate a premium of 7 cents, bringing the total cost to enter the position to $1.18. The maximum profit is equal to the difference in strike prices less the total cost of entering the position, which is $5 subtract by $1.18 equals to $3.82. As you can see from these examples, choosing strike prices that are spread out increases the maximum profit that can be made at the expense of reducing the risk mitigation that selling the second option provides. Credit spreads on puts. We will discuss options trading strategies that are intended to generate income. Income, generating strategies that involve puts and calls without the use of an iron condor can be spreads or traded naked. In this section, we will look at selling put credit spreads. When selling a put credit spread, it doesn't matter what the stock does as long as it doesn't fall below the strike prices. As a result, you intend to sell out of money put options before hedging your bets by purchasing a put option. It will assist in limiting your losses if the option you sell is exercised and the stock price falls below the second strike price. To create a put credit spread, sell a put option with a relatively high strike price. The strike price, on the other hand, should be such that the put option is out of the money. You don't want to sell an in the money put option because it will be exercised when it expires, forcing you to buy the stock. So we set up this type of trade in the hopes that the option will not be exercised because it is an income. Generating trade. We will receive a credit to our account for participating in it. Following that, we hope that the price moves in such a way that the options expire worthless. So, we'll hope that the strike price remains above the strike price of the put option that we sell, but we don't care what the stock does. The closer a put option's strike price is to the stock's market price, the more valuable it is. However, this increases the possibility that the option will expire in the money. So caution is advised. Many successful traders trade put options that are at least a standard deviation out of the money. It significantly reduces the likelihood that they will expire in the money. However, you will earn less money per trade, and you will need to engage in a large number of businesses to generate an income. The net premium you receive for entering the position determines the maximum profit on a put-credit spread. It is a sell-to-open position, and you will receive a net credit equal to the difference between the premium received for the higher strike price and the premium paid for the lower strike price. When the options are exercised, the maximum loss on the trade is calculated by buying and selling shares. The maximum loss will occur when the share price falls below the lower strike price. Even though you are given credit for taking this position, you must deposit collateral into your account in order to make the trade. The collateral is sufficient cash to cover the maximum loss that could occur. Let's take a look at some real-world examples. Google is currently trading at $1229.93 per share. A put credit spread can be created by selling a put option with a strike price of $1232.50 and purchasing a put option with a strike price of $1222.50. The expiration dates of the two put options used in a put credit spread will be the same. You make money on this trade by selling a put option, and you buy the other put option to limit your maximum possible loss. If the stock price drops unexpectedly, it is yet another strategy with a low risk and high reward. When entering the trade, this strategy has fixed profits and losses. The $1232.50 put option on Google is currently selling for $12.60. As a result, we sell it and receive the premium. The put option on $1222.50 is worth $7.60. We profit on this trade by the difference in prices required to enter the business. $12.60 subtract by $7.60 equals to $5. If the share price was at or above the upper strike price at expiration, we would earn $500 from this spread. Let's take a look at the potential losses now. Assume the share price remains below the upper strike price. The break, even point, is equal to the higher strike price less the premium paid. We're considering the buyer's break, even point, because we want to know when they'd exercise that option. With such a high price, $12.50 to purchase the put option, the break, even point, is $1232.50 subtract by $12.50 equals to $1220. 50 cents equals to $1220. As a result, the stock must fall to $1220 before it is worthwhile to exercise the option. But suppose the share price falls low enough that we incur maximum losses, as the share price falls below the lower strike price, say $1210 per share. In that case, the put option we sold will be exercised, requiring us to purchase shares of stock at the higher strike price of $1232.50. That's a bad scenario, but we can now sell them at the strike price of the other put option we bought to hedge our bets. As a result, we sell the shares for $1222.50. So we are currently losing $10 per share, but we have received a net credit of $5 per share. So after deducting this from our loss, our total loss on the trade is limited to $5 per share, or $500 in total. In many cases, the option may be more likely to be exercised. If the share price falls between the two strike prices, your losses will be lower than if it falls below or than if it falls below the lower strike price. The lower strike price's function is to limit the potential losses. To enter the trade, you would need to ensure that you had enough money in your account to cover any potential losses. So in this case, we'd need about $500 in our account to serve as insurance. Assuming you make good trades, you should not lose money most of the time. As a result, you can use your collateral repeatedly when making trades. In this case, you could repeat the business on a weekly basis. Most traders choose 3 to 4 stocks to focus on. This approach allows you to get to know the company well, enabling you to understand how the stock moves and make good strike price decisions. You could then trade Google every week by selling put credit spreads that expire on Friday. Using this method, you could earn a 6-figure income with only a few $1,000s in collateral. Credit spreads on calls. Another option is to use call credit spreads. Put credit spreads are preferred by traders in most market conditions. In a bear market, however, call credit spreads may be more appropriate because you expect the stock to remain the same or decrease in value with a call credit spread. A call credit spread involves selling a call option with a lower strike price and buying a call option with a higher strike price. To be successful, you will sell your out of money call option and hope that the call option remains out of the money. If a stock is trading at $200 per share, we could sell a call option with a strike price of $202 and a maturity date of 30 days for $346. Then, for $114, we could purchase a call option with a strike price of $210. So, in a call credit spread, you sell a chance with a lower strike price that is out of the money. Then you purchase an out-of-the-money call option with a higher strike price. The profit is fixed and equal to the total amount of credit received. As a result, if you purchase a call option with a lower strike price, you will receive more money than if you buy a call option with a higher strike price. If the share price rises, the call option you purchase will help you mitigate the risk. If the share price rises above the higher strike price, the maximum losses will occur. In that case, you will be assigned and must sell shares of stock at the lower strike price, but you can then buy shares at the higher strike price and sell them on the market to recoup some of your losses. The maximum loss will be the difference in strike prices less the net credit received. Purchasing back to close. If you sell put or call credit spreads, buying back to close is an excellent way to avoid assignment. You want to wait until it is nearing the end of its life. Most options are not exercised until they expire, so you can buy back to close and avoid assignment if the trade has gone wrong, which means the share price has moved against the business, or if you are afraid of a dramatic move in the share price on the expiration day. Assume you are unconcerned about stock price fluctuations and your options are out of the money as expiration day approaches. In that case, you can let the options expire worthless and still profit handsomely from the trade. Strangles and straddles. When the stock is expected to make a significant pricing move, but you don't know how it will move, this strategy is used. It entails purchasing a call and a put option in a single transaction. A strangle is formed by defining an expected stock movement range and using different strike prices for the put and call options. The put option has a lower strike price, while the call option has a higher strike price. The expiration date for both options will be the same. The maximum profit on the upside is theoretically unlimited. but it will be determined by how far the stock price rises above the strike price of the call option. If this occurs, the put option expires worthless, and your net profit is the difference between your profit from selling the call option and the cost of purchasing the put option. If the stock price falls, the maximum profit will be made in the improbable event that it falls to zero, less the cost of the call option. Strangle. A strangle is created by combining a call and a put option to define a stock price range. In contrast to the iron condor, the goal in this case is to profit when the stock price moves outside the boundary that we have established, rather than profiting when the stock price remains within it. As shown in the graph below, we will benefit when the stock price is outside of the two boundaries set by a call and a put option. Furthermore, it is simpler than an iron condor because we will purchase two possibilities to trade. The goal here is to profit from a significant change in share price that can move either up or down. So first, you buy a call option at one strike price, forming the upper boundary for the trade. Then you buy a put option at a lower strike price, but with the same expiration date that sets up the lower limit for the business. The profit potential for a strangle is quite significant. In theory, the profit potential on the upside is unlimited. But of course, stock prices don't increase without a limit in the real world. So we will look at a specific example to handle potential profits. So, if the stock price breaks to the upside, the put option will expire worthlessly. This is because you are out the price paid for the put option. Conversely, if the stock breaks to the downside, the call option will expire worthlessly. The setup has two break-even points on each side of the trade. On the upside, the break-even price is the call option strike price plus the total premium paid to buy the two options. On the downside, the break-even point is the strike price of the put option minus the unlimited premium paid to buy the two options. So, let's say that we have a stock trading at $200 a share, and we will set up a strangle before an earnings call. First, we can buy a call option with a strike price of $202 for $210. Then, we can buy a put option with the same expiration date with a strike price of $198 for $205. This way, our total cost is $415 to enter the trade. The break-even price on the downside is $198 subtract by $2, 5 cents equals to $195.95. If the stock price drops, it has to drop at least $195.95 before making a profit. On the upside, the break-even price is $202 added to $2.10 equals to $204.10, and so the stock price has to rise at least to $204.10 before we can start making a profit. We are assuming that we buy these options 14 days to expiration. Let's say that there is an earnings call in 7 days so that the price action will take place with 6 days to end. We will assume that the stock price didn't move very much in the interim. If there are no other changes at 6 days to expiration, the put option is now valued at $109, and the call option is valued at $1.12. So they have lost quite a bit of value. However, calls' implied volatility tends to go up a lot before earnings. We will assume that implied volatility spikes to 45s before the earnings call for our exercise. Under these conditions, the call option is priced at $370, and the put option is priced at $364. That gives us a total of $734. They are just based on the volatility we could sell at a profit. Now let's say the earnings call has some surprises and beats expectations. For a $200 a share stock, a rise in the price of $10, $20, or more is not unusual. Let's say that it rises $20 a share overnight. That causes the put option to drop to $16 in value, so it isn't essential. The call option spikes to $18.10. We can sell it at a massive profit found by subtracting the cost of entering the trade. $18.10 subtract by $415 equals to $13.95 equals to $13.95. Now let's say that instead of the earnings, call has a lot of bad news, and the stock plummets to $170 a share the following morning. In that case, the put option increases in price to $2,800. This time, we make a profit of $2,800 subtract by $415 equals to $2,385. So, we see from this example that we can profit with stock moves in either direction. What if the stock stays in the range? In that case, we will lose money on the trade. The maximum loss incurred will be the price paid to buy the options. If the share price stays between the two strike prices, both options will expire worthlessly. Straddle. Now we'll look at a similar trade known as a straddle. A straddle also intends to profit from a breakout to either side. We will purchase a call option and a put option in the straddle case, just as we would in a strangle. In this case, however, we will have the same strike price and expiration date for both. The goal of a straddle is the same. We hope to profit from large price movements in either direction. Up or down is fine. In theory, the maximum profit is unlimited if the price moves to the upside. In reality, it will be a finite value less the total cost of purchasing both options to enter the position. Assume we are trading Facebook stock at $186 per share. With 10 days until expiration, we purchase a call and put option with an at-money strike price of $186. With a high level of volatility, say approaching an earnings call, the price of each option would be around $429, making the total cost to enter the position $858. Assume Facebook announces their earnings 5 days before the expiration date. If the earnings call revealed good news, the stock price could rise to $15 per share. In that case, the put option expires worthless, and the call option increases in value to $1,532, giving us a profit of $1,532 subtract by $858 equal to $674. If the news was bad and the stock fell $20 per share, the call option would be worthless and the put option would be priced at $2,004. Our total profit would be $2,004 minus $850. For a total of $1,146. Condors made of iron. One of the most popular option strategies is the iron condor. It is a profitable strategy, and an iron condor is sold for a net credit. Keep this in mind, there's a lot of misinformation about iron condors. An iron condor is sold by combining a call credit spread and a put credit spread into a single trade. The two options with inner strike prices will be offered for sale. Assume, for example, that a stock is trading at $200 per share. You could sell a $205 strike call option and buy a $210 strike call option. You would simultaneously sell a put option with a strike price of $195 and buy a put option with a strike price of $190. You will profit as long as the stock price remains between the inner strike prices, which, in our example, are $195 and $205. When you expect the stock price to remain stable over the life of the options, you use an iron condor. The expiration date of all options used in an iron condor is the same. Determine the levels of support and resistance before deciding on your strike prices. You want to set the strike price of the put option you sell slightly above the support price and the call option's strike price slightly below the resistance price. Then, for the purchased call option, set the outer strike prices slightly above the resistance price level and slightly below the support price level. Many traders make a living solely from selling iron condors. The chart takes the following shape. You will receive a net credit for the call credit spread, and for the put credit spread, you will receive a net credit. Your maximum profit is equal to the total credit received. Profits will be earned if the stock remains between the inner strike prices. The iron condor has the added benefit of limiting losses. If the stock rises, the maximum loss is equal to the difference in the strike prices of the two call options. If the stock falls, the maximum loss is the difference between the strike prices of the put options. In our example, a $5 loss per share, total $500, would result if the stock moved below $190 or above $210. The reason for the iron condor. The iron condor is a trade that combines a put credit spread and a call credit spread into a single transaction. I understand that it appears to be highly complicated. We are now discussing 4 options in a single trade, but the truth is that it isn't that difficult. So, to set this up, you estimate the stock's range. So you want to look at the stock over a reasonable period and then determine the lowest share price it will reach. It does not predict what will happen in the future, but it does provide us with a boundary point to work. It all comes down to playing the probability game. So we are estimating the likelihood that the stock will remain within a specific range of values. Now, we repeat the process for the upper bound. Again, if a stock's price does not change significantly, it will range between these two values with no breakout. It is the secret to the iron condor's success. The first step is to sell a call option with a higher strike price. Then, at the lower boundary price, we sell a put option. We gain a net credit by selling these two options. The iron condor, on the other hand, is a low-risk strategy. To reduce risk, we will purchase 2 options on the outskirts of the range. You will buy a put option with a lower strike price than the one we sold. As you can see, we've created a put credit spread. Following that, we purchased a call option with a higher strike price than the call option we sold. As a result, it creates a call credit spread. However, when you combine the two into a single trade, you create an interior boundary for the stock to move within. Suppose that a stock is trading at $100 a share. We might be able to sell a call option with a strike price of $105. Then we could sell a put option with a $95 strike price. It establishes our profit zone. We are in a good position as long as the stock remains in the $95 to $105 per share range until the option expires. To reduce risk, we purchase 2 options with outside strike prices. So we could buy a call option with a strike price of $110 and a put option with a strike price of $90. The strategy is to wait and hope that the stock price does not fall. You can let the options expire and profit from the net credit you received if it does not. The net credit will be distributed as follows. Credit received for selling at a high strike put plus credit received for selling at a low strike. Call deducted for a high strike price call removed for a low strike price put. There is some debate over whether or not to buy or sell an iron condor, but those who argue are perplexed. You're offering an iron condor for sale. It's because you're selling to open and you get a net credit for the transaction. If things go wrong, if the stock does have a breakout one way or another, you will have losses, but they will be capped. You can always repurchase the iron condor to close the position if it doesn't work out. If you are risk-averse and concerned about something extraordinary happening with the stock on expiration day, you can always buy back the iron condor to close the position early. However, keep in mind, the move will reduce your profits, which are already limited by the credit received for entering the place. When should you use an iron condor? When a stock is not to move much, you should use an iron condor. Some people choose shallow delta values such as 0.16 that are far out of the money. It can provide the stock with a broader range of values to oscillate around, resulting in lower profits per option contract. It increases the likelihood of making a profit. So once again, we have a trade-off. When the stock has high implied volatility, you should avoid using an iron condor. High implied volatility indicates a greater likelihood that the stock will move outside of one of the boundaries you've established with the iron condor. One situation in which an iron condor would not be appropriate is before an earnings call. You don't want to be holding an iron condor before the earnings call. However, if the stock rises to a new range, it may be possible to use an iron condor to generate income from the store after it has settled. For iron condors, you could invest in low volatility stocks. For example, a relatively stable supply like IBM could be a viable option outside of earnings season. However, as with any options trade, you should check the open interest in the options you are considering for your iron condor. What is the purpose of using an iron condor? Traders use iron condors because they are a low-risk strategy that can generate consistent income from trading. Selling an iron condor is similar to selling a put credit spread in that you will need to provide collateral to cover the trade. So, while the iron condor is in your account, the money you used to cover it will be locked up until you either close the position or let the options expire. Assuming you don't lose money because the share price remains within the range you've set up for the trade. Consider the following real-world example. When the share price rises above the high strike price call or falls below the low strike price put, the maximum losses occur. The high strike price call in this example is $215. The low strike price for the put option is $180. $7.50. On the plus side, if the stock price rises above $215, the maximum loss is $55. On the downside, the maximum loss is $305 if the share price falls below $187.50. The collateral required is always the greater of the two potential losses, so you'd need to deposit $305 into your account to participate in this trade. As you can see, the maximum profit of $195, the credit received for selling to open the position, is realized if the share price remains between the inner strike prices. The risk of the assignment is the same as it is for a put credit spread or a call credit. Spread it is nothing to be concerned about. If a project occurs, the broker is handled automatically, and the stocks are bought and sold without your knowledge. As a result, the credit received per share is $1.95. As a result, the upper put strike price represents the break. Even point on the downside minus the credit received, which is $192.50. $1.95 equal to $190.55. The lower call strike price provides the upper break even point plus the credit received, which is $212.50, $1. 95 cents equal to $214. 45 cents equal to $214. 45 cents. Out of. The money values are used for strike prices. An iron condor strategy is a non-directional strategy. You only care that the share price stays within a specific range of values. You don't care if it rises or falls within that range. Spreading butterflies. Credit and debit spreads are best when a stock has a clearly defined positive or negative market outlook. However, If an underlying asset exhibits a neural view in the market, butterfly spreads are the best strategy to capitalize on the market. A stock trend is neutral when there is no sideways movement or dominant trend to determine whether an asset is negative or positive. Butterfly spreads are a hybrid strategy that combines bull and bear spreads. It incorporates 4 different options contracts but has the same expiration period. These various contracts will form a price range to determine the trade's losses and profits using 3 different strike prices. The distance between the upper and middle strike prices must equal the distance between the middle and lower strike prices. The options trader would have to sell 2 contracts at the midpoint strike price. The options trader purchases 2 contracts at the upper and lower strike prices. Butterfly spreads use both call and put options to reduce risk over a specified period. As a result, the trader's losses are limited to the initial investment and maximum profits are realized when the asset price is near the midpoint. As a result, it is critical to consider the state of neural market analysis before employing the butterfly spread to reduce risk while maximizing option profitability. Collar of equity. The purpose of this strategy is to mitigate risk. It is applied to a long stock position and used by large traders. So, to employ this strategy, you would need a large number of shares of a particular stock. If you're unsure about the direction of a stock you own, you can use an equity collar to hedge your risk with put and call options. You set it up by purchasing an equal number of put and call options with strike prices higher than the share price for the call options and lower than the share price for the put options. All of the options will expire on the same day. Short gut. A short gut is a less common option strategy in which a call and a put option are sold simultaneously. You sell the 2 options with the same expiration month but not the same expiration date. You first sell a call option with a specific strike price, followed by a put option with a higher strike price. If the stock price moves in either direction, the maximum losses are uncapped, so you hope the stock price stays the same. As a result, the maximum profit is the premiums received from selling the options. This strategy is rarely used, and you must be a level 4 options trader with enough cash in your account to cover the cost of selling the 2 options. Cash as collateral. Long gut. Buying a call option and a put option with a higher strike price is what a long gut entails. In this case, you're hoping to profit from the stock moving in either direction. So it's similar to a strangle, but with the call strike prices reversed, and the put strike prices reversed, and the put strike prices reversed. If the stock price rises, you will profit from the call but lose money from the put. Conversely, if the strike price falls, you will benefit from the call but lose money from the put. Synthetic methodologies. Small traders rarely use synthetic strategies because they are obscure. A large margin account is required to execute a synthetic put. To set it up, you will borrow shares of stock from the broker and sell them on the market, hoping to repurchase them at a lower price. Then you'll purchase a call option on the same stock. If the stock price rises, you will profit on the call option, which will help offset the loss of buying back the shares at a higher price. If you borrow shares from the broker, you must repurchase them and return them to the broker at some point. If the stock price falls as expected, you will lose money on the call option because it will expire worthlessly, but you will profit from shorting the stock. You can repurchase it at the lower share price, return the shares to the broker, and your net profit is the difference between that profit and the cost of the call option. As a result, this involves shorting the stock and insuring it with a call option. If the share price rises above the call strike price, your call options will profit, while your put options will expire worthlessly. If the stock price falls below the strike prices of the put options, the call options will be worthless. You have the option to exercise the put options and sell your stock at a higher price than the market price, or you can sell the put options and keep your stock. In contrast to spreads, It will show that an iron condor has losses on both the upside and downside, with a range of profitability in between. The losses are not always equal. In this example, we'll look at an iron condor with strike prices of $192.50 and $212.50 on Facebook. It's a reasonably broad range. It's wide enough that it might survive the upcoming earnings call. On the negative side, the break. Even price is the strike price less the total cost of entering the position. If the stock price falls, it must fall by at least this amount before profits can be earned. The maximum possible loss would occur if the share price remained constant at the strike price. The straddle forms a V shape on a profit and loss graph, with the bottom representing the maximum loss at the strike price. It is a net debit, similar to a strangle, and so you buy to open this position. In theory, the stock could lose value to the downside, but this is an infrequent occurrence. In either case, significant drops in stock prices, such as after an earnings call, can still result in large profits. Someone can calculate the break. Even price is the strike price plus the total premium paid to enter the position to the upside. In this case, the stock price must rise by at least one amount before profits can be earned. You can profit if the stock price falls below the break-even point of the put option. A straddle serves the same purpose, but in this case, the strike prices of the call and put options are set to the same value, and both options expire on the same date. The goal of a straddle is for the stock price to move away from the strike price in either direction. The maximum possible loss is equal to the cost of purchasing the options. The strategy is regarded as neutral because it will profit whether the stock rises firmly or falls strongly. When you expect a significant move in the stock, you will invest in this strategy, which is why many traders buy strangles before an earnings call. Most earnings calls cause important price movements in the stock, but you don't know which way it will move before the call. The strike prices chosen for the call and put options are both out of the money if the stock rises, the break. Even price is for the call option. If the stock falls, the break-even price is for the put option. For instance, if the share price was $100 and it was expected to move significantly, you could set up a strangle with a $105 call option and a $95 put option. You will lose money on the trade if the stock price does not move above the call option strike price or below the put option strike price. Chapter 2. Advanced Strategies. Long call. Options terminologies can be perplexing at first, but once you understand the fundamentals, you'll be fine. Long denotes a purchase, while short denotes a sale. A long call option entitles you to purchase an underlying stock at strike price A. It allows you to tune your game without the risk of being wiped out if you trade directly in the stock market. If you are bullish on a stock, meaning you believe it will rise in value at some future point, you can either buy the stock outright or use a long call option. Of course, you will profit from a long call option. if the stock rises as predicted. However, you will only lose your paid premium if the opposite occurs. Aside from that, long calls are less expensive than buying the stock outright. If you were investing in the stock market, a stock that did not rise could disappoint you. You will face numerous risks because you have already purchased a portion of the company's stock. Assume you're thinking about entering the market with a bullish strategy. In that case, you must thoroughly analyze the time horizon over which a chosen stock moves in a specific direction, as well as the number of points required for that stock price movement. To reduce risk, most people buy more short-term, out-of-the-money calls. However, it can be risky if all of those calls have not successfully moved to indicate again. Extended call options are the first way to enter the market. Because of its simplicity, this is where most new options traders start. At times, Long calls can be difficult to profit from, but they are not as complicated as advanced option trading strategies. Long call option strategy risk or reward analysis. The following are the risks and rewards to consider when employing this strategy. It only requires a small amount of money, making it appealing to new options traders. Furthermore, it assists traders in managing their portfolios and avoiding trading in stocks that are expensive to purchase. The loss is only limited if the underlying stock falls rather than rises. It is preferable to risk a small amount of money rather than lose it all in an underlying stock trade. Before carrying out the stock option plan, there is no need to perform complex calculations. It does not necessitate margin debt and has lower commissions than other complex option trading strategies. Don't put all of your money into a long call option, purchasing numerous out of the money item. Because call options are inexpensive, they can cause you to lose your trading capital. You must understand that the call option is subject to time decay, which depreciates as the expiration date approaches. Simple long call option calculation. To minimize your losses and maximize your gains, you must perform a simple calculation to understand how the entire long call options work. A break, even point is reached when the underlying financial instrument has not lost money. The following example will help you better understand this. Schwab Center for Financial Research is the source of this information. Strategy at expiration. One guy's long 4 for the June 50 call. Maximum loss is equal to a 400.0 option premium paid multiplied by 100 contracts. Break even is equal to E54, 4 option premium added to 50 strike price. Maximum profit is equal to limitless. To determine the profit potential before aspiration, use the following formula. Profit is equal to EU, raise in underlying stock, multiplied by delta value or call option price. The disadvantage of a long call option is its finite lifespan. As a result, the underlying stock must move quickly above the break, even point to generate unlimited gains for the owner. The downside is that the option's owner may lose a premium if the underlying stock does not rise as expected. Long story short, this strategy is related to the long call strategy. The only difference would be your market outlook. For example, if you have a solid bearish stock outlook, you can use the long put option strategy. Even with the long put strategy, your profit potential is limitless. The greater your profit, the lower the stock price falls from the strike price. Unfortunately, if the stock price remains above the strike price, even on the day of expiry, your options contract will be worthless. However, even in a long put strategy, your risk is limited to the premium price. You will be under no obligation to pay anything more if the stock remains above the strike price. In a long put strategy, you buy the right to sell stocks at a fixed price now, even if the stock's current trading price is much lower. Take, for example, the fictitious stock Gabzo once more. It is currently worth $50. The expiration date is in 26 days. You will have several options from which to choose. We'll look at 3 different scenarios. Moneyness or strike price. Current in the money price, $45, $35, $8. ATM, $40, $35, $5. OTM, out of the money. $38, $35, $2. Assume your market prediction is correct, and your stock price falls to $35. Strike price minus current price equals value. Because one lot contains 100 shares, your profit would be multiplied by 100. In the ITM, your profit would be $1 x 100 and $300. In the ATM, your profit would be $11 subtract to $5 is equal to $6 multiplied by 100 is equal to $600. In the OTM, your profit would be $11 subtract to $2 is equal to $9 multiplied by 100 is equal to $900. As with the long call strategy, the highest profit would be in OTM trades, including put options. On the other hand, beginners should avoid taking OTM puts because they are extremely risky and have a meager chance of hitting the target. As a result, you are more likely to lose your entire investment in such trades. For new traders, it is usually better to look for ITM or ATM trades early in the month. Premium. The fig leaf. Optional fig leaf trading, like its literal meaning, is something one should hide behind from the enemy. It's used to conceal a short position. In this case, it is a long option position used to conceal the writer's short work in the stock or long position in a call. The strategy's goal is to mitigate the overall risk of the trade. As a result, it is an adjustment rather than a plan to reduce risk or leverage. Call spread. Long call. Long call spread is a more sophisticated strategy frequently used as a covering trade. The long call spread involves purchasing 1 month or more distant call options with strike prices equal to the strike price of the underlying stock and selling an out-of-the-money call option. The long call spread is also known as the butterfly spread or the double butterfly spread. The long call spread will provide the following benefits if executed correctly. 1. It mitigates the risk of owning the underlying stock in exchange for a small premium paid for both options. 2. It provides an income stream from both options, long and short, at expiration and until one is exercised, implying an unlimited time decay risk. 3. It increases the likelihood of profiting from a stock move. 4. Because the prices of both options are highly correlated, the position is typically covered. 5. The trade can be exited with a minimal capital loss. 6. It can be done on any strike price range, though the long call spread is most commonly used on stocks with relatively narrow price ranges, for example, stocks with a range of only 50 cents to $1. 7. It may incentivize buying and holding the underlying stock as its value rises, especially if selling puts was part of the strategy. Long put spreads. Long put spreads are frequently used in tandem with short stock positions. The long put spread entails purchasing 1 month or longer put options with strike prices equal to the underlying stock's strike price and selling an out-of-the-money put option. When executed correctly, the long put spread, like the long call spread, will provide the following benefits. 1. It mitigates the risk of owning the underlying stock in exchange for a small premium paid for both options. 2. It may incentivize buying and holding the underlying stock as its value rises, especially if buying calls was part of the strategy. 3. Because the prices of both options are highly correlated, the position is typically covered. 4. The trade can be exited with a minimal capital loss. 5. It can be done on any strike price range, though the long put spread is most commonly used in relatively narrow strike price ranges. Price ranges, for example, stocks with a 50 cents to $1 range. 6. It may incentivize buying and holding the underlying stock as its value rises, especially if selling puts was part of the strategy. 7. It increases the likelihood of profiting from a stock move. Call spread, short. It is a generally sound strategy. However, it necessitates a high trading level, which is not always feasible for tenderfoots. A credit spread is created by combining 2 transactions. When traders believe that their underlying stock has reached its upper resistance level, they employ another directional strategy. They don't think the underlying stock will rise much further at this point. They usually believe that the stock's price will remain stable and not change or fall. It will be the inverse strategy discussed earlier with the bull-put spread, the bear call spread. Like the bull-put spread is a credit spread. It means that the premium you receive when selling one leg of this trade will be greater than the premium you pay when selling the other leg of the business. As a result, if you accept this position, you will receive a net credit to your account. The first step in creating your bear call spread is choosing the appropriate stock for this strategy. You will find a variety of stocks to choose from, but you must do so based on your outlook for this type of index. The next step is to sell an OTM call option on the stock you've chosen. Third, you should buy an OTM call option with the same expiry date and underlying stock as your ATM call option, but the second one should have a higher strike price. Once you've entered the market, you'll want to keep a close eye on your position every day. Once you have made a significant profit, roughly half of your maximum profit, it is time to exit your place. Once you have begun to recognize some market signs and are confident that the stock will not reverse, you could wait until it reaches its expiry date and then take the maximum profit. Spans are sometimes crowned as better than others for entering a bear call spread. It would help if you use the bear call spread whenever you believe that your chosen stock is unlikely to rise in price shortly and will most likely decline from its current cost rather than rise. It can happen, for example, when stock from a company with high market expectations posts results that fall far short of the market's expectations. In addition, the index option may encounter a high resistance level, causing it to fall slightly. This method will not work well if the stock is volatile and can rise significantly in the short term. You'll want to select options that aren't likely to increase in price soon. You would then use the bear call spread to profit whether the stock price remained stable or fell. When the bear call spread expires, the stock price is trading below the strike price of the call option sold. You will make the most money. To maximize your profit, you must take the premium received or sell the lower strike call option, less the premium paid for purchasing the higher strike call option. Then multiply both of these numbers by the lot size. When the stock price is trading above the strike price, the call option you purchased with the higher strike price at expiry will incur the most loss with this type of spread. For this reason, you must select stocks that will either fall or remain stable. If the stock rises due to this option, you will end up losing money. So it is an excellent strategy to use if you believe the market is about to fall or if you are working with a stock that is not increasing. The most significant advantage of using the bear call spread is ensuring that time decay will work in your favor. As long as you choose a stock that can stay below your lower strike price when it expires, you will be able to keep the entire credit that you received when you entered into this position, and you will have the opportunity to profit. However, there is a drawback to using this strategy. Assume you notice that there is a chance that the stock will make a significant movement that is contrary to your expectations. In that case, the maximum amount you could lose is much more important than the maximum profit you could make using this strategy. So there is some risk. Spread on short puts. The trader who writes a put option is known as the seller. In this case, an options trader must purchase the underlying stock and ensure that everything is ready when the buyer exercises the option, because the seller is obligated to buy shares of the underlying stock before the buyer decides to exercise the option. Right? A short put option is also known as a naked or uncovered put option. Losses may occur if the short put option expires worthless without the underlying asset rising above the put option strike price. As a result, a short put should be used if you believe the underlying security's price will rise above the strike price determined in the options contract. To profit from options trading using a short put strategy, you must ensure that the technical analysis results in a rise in stock price. When the stock price falls throughout the option period, the option buyer may exercise the right, causing you to incur potential losses. However, you will profit from the premiums paid when the put options contract is signed. Aside from making money through tips, by opening a put option, you can also sell a stock at the underlying price of the financial market. Assume that a stock is currently selling for $100 in the financial market. You want to purchase the stock for $75. Consider selling a put option with a strike price of $75 and receiving a premium of 2.0. If the underlying stock's price falls to $75 as predicted, you will be able to keep the tip while also purchasing the underlying stock at the strike price. One of the riskiest strategies is the naked put. As a result, only professionals should use it. However, selling naked puts can be even safer and more profitable than purchasing stocks when this occurs. When you sell a nude set, you assume that you must purchase the stock at a specific price on or before a particular date, so you'll raise the price for that. If you don't go overboard, sales puts can be a good strategy. So, if you sell nude stocks for $50,000, make sure you buy shares for $50,000 as well, because you may need to continue. Selling naked puts has the following advantages if done in moderation. 1. Stocks do not have to rise. You don't have to sell profitable naked put shares when you sell them. You are not required to sell stocks at a loss. If you have trouble finding moving stocks, it will allow you to make money. Of course, instead of caring for it, you could always sell the sets. 2. You can be compensated for purchasing a stock. You must buy the shares if they fall below the exercise price. However, because you received the bonus in advance, it means you were paid to invest in a healthy stock, which is far superior to buying and maintaining an old way. And if the company has strong, long-term growth, you can wait for the weather to improve before selling covered calls for a higher premium. 3. A bonus has been added. Premium collection accumulates over time and can be very profitable in the long run. You can often earn more money by selling sets, and you can do so by keeping stock on hand. Is it risky to sell naked puts? Selling puts can be a great way to make money and get into stocks, but getting too far away can jeopardize your strategy. Let's look at two different examples of naked sets for sale. In example 1, Mike has $3,000 in his possession. He wants to invest in an ETF or large sums of money, and he discovered a fundamentally sound stock trading at $33 per share. As a result, he can now buy and hold 90 shares of that stock or sell it for $30. Mike chooses the second option and sells $30 well. Now he will be paid $150 in advance and will be required to purchase shares worth $30 if the price of the shares falls to $30 or less. One of two things can happen from here. 1. The price of the stock will fall below $30. He pays $30, which is less than we had to pay. Mike also has a $150 price that he can make up and keep stocks for an extended period. 2. The price of the stock remains above $30. Sold is worthless and runs away with $150. Mike may decide to sell another set next month because he has extra cash. In this case, selling the well is not a bad idea. Furthermore, selling a well can be even riskier than buying stocks directly because we make money up front, lowering our costs. In the second example, Fred also makes a $3,000 investment. He decided to begin selling significant amounts of stock. He sells one share of XYZ, one of ZTF, and one of ABC for $400, but he must buy $10,000 if everything goes wrong. In this case, Fred is selling high-risk naked sets. Any shares you sell for a bear placement must be held for an extended period, and you must be able to repurchase those shares if necessary. If all of the shares went to Fred, he would have to pay $10,000 for them. However, because he does not have $10,000 in his account, he will be issued a refund, potentially reducing his account balance to zero. In short, the sale of naked puts should be approached as an investment rather than a commercial transaction. You should not sell it naked if you are unwilling to buy and maintain security. Selling naked puts is a fantastic, low-risk profit strategy. It is a powerful tool for any trader because it allows the investor to purchase preferred stock at a price that suits him while also receiving a discount. Furthermore, it is a simple strategy that does not necessitate daily computer screen viewing or technical analysis hours. Naked puts. How do they work? For instance, if XYZ shares are trading at $45, the trader may sell the put for $40 before the next maturity date, no longer than 30 days. It means that if the stock falls to $40 before the end of the sale, the trader will have to buy 100 shares for $40, totaling $4,000. As a result, if the put's cost was $1, the trader would make an initial profit of $100. If put is redeemed and must now purchase shares, his net price is $40 subtract by $1 is equal to $39, or $3,900, or $3,900. If the stock does not fall to $40 before expiration, the put will be worthless. The trader keeps $100, and he may sell another set next month, allowing for another discount if his put is ever exercised. In theory, traders could hold it indefinitely and eventually buy stocks free. Even if he never buys shares, he still has a nice monthly income to make a simple transaction. When is it time to sell a naked put? Don't forget to select the event that you want to own. You examined the fundamentals and concluded that the long-term outlook remains optimistic even as stock prices fall. Perform a simple analysis of general market trends, S&P, NASDAQ, or DOW, and your share sector groups. The simplest way is to look at the index for this group. Never sell naked puts in an apartment complex or a developing market. Never sell in a constantly declining market. If the exchange or sector is trending downward, make sure you understand the support areas and their strength. It will instruct you on where to place your put. Use an options calculator, such as the one available for free at OptionView Research, to select put in the range where the stock price is likely to end above the highest target of 80% or higher. Sell puts no later than the next month's due date. Wait for the put option to expire or to be executed. Then, if it passes, repeat the process the following month. What else should I know? Although naked put is a safer and more profitable strategy than stock trading, options brokers consider selling naked put to be a risky strategy. If your put option is exercised, your broker will want to know that you have enough money to buy the selected shares. The formula varies by broker, but a margin requirement is usually required 12% of the total purchase price of the stock if it has been exercised. Why is such a large margin required? In theory, if you buy a stock at put's best price, it may collapse and continue to fall until the stock is worthless, leaving you in the dark with the stock you overpaid for. This, however, will never happen if you do not play and do not make an informed decision and selection of your share. Before we get into the specifics, here's a visual representation of the naked put strategy. Selling naked puts is the only logical way to buy stocks because you get them at a lower price. Why pay more? In any case, if you typically invest in stocks, you have sufficient funds to meet your margin requirements. This is an excellent way to generate monthly income in a neutral or bull market. It is safe, dependable, and cost-effective, and best of all, it does not necessitate a thorough understanding of technical analysis. Knowing the fundamentals and performing simple trend analysis ensures that trading is secure. Long straddle. In a long straddle, you will buy a put and a call for the same underlying stock at the same time. You'll also need the same strike price and expiration date. This method can be used with a highly volatile supply. As a result, you have the opportunity to profit regardless of how the stock performs. Before we get into how this works, let's take a step back and remember how we determine whether a deal will be profitable. We're looking at it from the buyer's point of view. When you buy a call option, you profit when the stock price rises above the strike price. You must, however, remember to include the premium in your calculations. For example, if you believe a stock will rise above $54, but pay a $1 dividend per share, you must invest in a call option with a strike price of at least $55. You're playing the same game in a put option, but you're hoping the stock will fall below the strike price. So, in our new scenario of purchasing a call and a put at the same strike price and expiration date, we will buy a $55 put. To keep things simple, we'll stick with a $1 premium. You must know the net premium, which is the sum of the bonuses from the call option and the put option. In this case, $2. When one of two conditions is met, you can profit. The underlying stock's price is more significant than the strike price of the call plus the net premium. In our example, you will profit if the underlying stock price is more excellent than $55 added to $2 is equal to $50. $7 is equal to $57. Underlying stock price, strike price of put subtract by net premium. In our example, you'll make money if the underlying stock price is less than $55. $2.53. When the contract expires with the underlying trading at the strike price, the maximum loss for a straddle occurs. In that case, both contracts will expire and you will be out the premiums you paid for both options. There are two break, even points in a long straddle. They are as follows: lowering the break, even point, net premium strike price and net premium, E upper break, even point. Keep in mind that you purchase both options with the same strike price and expiration date. Let's take a look at an easy example. In May, the stock is trading at $100 per share. The investor pays $100 for a call with a strike price of $200 that expires on the third Friday of June. In addition, the investor purchases a put option with a strike price of $200 that passes on the third Friday of June for $100. The net premium is equal to $100 plus $100 for $200. Assume the stock is trading at $300 on the expiry date. Because the underlying stock price is far above the put's strike price, the put expires worthless. The investor's call option, on the other hand, passes in the money with an intrinsic value of 100 multiplied by $300. Subtract by $200 is equal to $10,000. The investor has made $9,800 after deducting the premium. On the other hand, assume that the stock falls in value and is trading at $50 on the expiration date. The call option expires worthless this time. The investor can purchase 100 shares at $50 each for a total of $5,000. He can now sell them to exercise the put option at $200 per share. For a total profit of $20,000, subtract by $5,000 subtract by $200 is equal to $14,000. $800 is equal to $14,800. It's a fictitious example, so whether the numbers are realistic or not isn't necessary. What matters is that the investor will profit regardless of what happens to the stock price. Long strangle. This one will feel similar to the long straddle, but a few subtle differences will help it stand out. One of the most noticeable differences is that while the put and call options are still the same and will be on the same asset and expiration date, they will have a different strike price for both of these. The price you use for your call options will be slightly higher than the price you use for your put options. However, both of these prices are exorbitant. This option is less expensive than working with the long straddle, but it is best used when you believe the asset price will move up or down in a much shorter period. You buy a put option and a call option with the same expiration date and underlying asset, but at different strike prices. In this strategy, the put option's strike price will be lower than the call option's strike price. Both options should also be unprofitable. Use this strategy when you believe the price of an underlying asset will move significantly, but are unsure how much. With this strategy, your losses are limited to the cost of the two options. Because the options are purchased out of the money, a long strangle is typically less expensive than a straddle. The advantage of choosing this long strangle over the long straddle is that the premium you will have to pay will be less than what you would have to pay with the long straddle. However, the market move must be much more prominent to recover your costs for the long strangle to work. Traders will profit from the long strangle position whenever there is a sharp move in their stock, similar to the long straddle position, and you can still make unlimited profits. However, the maximum loss will occur with this strategy if the stock price settles between the strike prices of the call and the put when the expiry time arrives. Thus, the maximum loss in both the straddle and the strangle will be the premiums you paid for the put and call options. Back spread with calls. To create a call ratio back spread, you must buy calls in the right calls. Because it is a ratio spread, the number of options executed in each transaction will differ. As a general rule, try to buy 2 calls for every call you write. Furthermore, always ensure that the total credit for your written contracts exceeds the total debit for contracts you've acquired. Backspread W or puts, you will profit if the price of the underlying asset moves in either direction. However, your profitability increases if the cost of the underlying asset falls rather than rises. You must purchase puts and write puts at the same time. Of course, both of these transactions will be based on the same underlying asset. The only difference is that instead of buying an equal number of puts, you will buy 2 puts for every put you correctly guess. The puts you buy must be at the money, while the ones you write must be profitable. The expiry date and the underlying security must both be the same. Calls on a long calendar spread. This strategy is intended for a trader who wants to profit from the associated assets remaining stagnant in the market while also benefiting from the long-term call position if the stock rises in value in the future. Long calendar spread W or puts. You will profit if the price of the underlying asset moves in either direction. However, your profitability increases if the cost of the underlying asset falls rather than rises. You must purchase puts and write puts at the same time. Of course, both of these transactions will be based on the same underlying asset. The only difference is that instead of buying an equal number of puts, you will buy 2 puts for every put you correctly guess. The puts you buy must be at the money, while the ones you write must be profitable. The expiry date and the underlying security must both be the same. Calls on a long calendar spread. This strategy is intended for a trader who wants to profit from the associated assets remaining stagnant in the market, while also benefiting from the long-term call position if the stock rises in value in the future. When you know the overall trend is still bullish, but the stock is moving sideways or experiencing counter-trend enthusiasm, The bull-put spread works like a charm in a sideways market. It's an excellent way to supplement your income in the meantime, and it's a lot safer than trying to time a directional entry. A bear put spread is most effective when a bear trend accelerates to the downside. Of course, in an extended market, you could use this to hedge your positions, but that isn't a trading strategy in and of itself. As it stands, using it in the manner described above is your best bet for making money from it. The term is derived from the way option chains are displayed. Vertically, the strike prices are listed with the puts and calls arranged on either side of them. As a result, the lower strike price is higher than the current price, while the higher ones are lower. As a result of using two legs on the trade, you're creating a vertical spread, according to the option chain table. With a calendar spread, you're on the same strike price as before, but instead of moving up or down the calendar, you're moving sideways or horizontally to the next month. As a result, the term horizontal spread was coined. You may have also noticed that some strategies pay you immediately upon entry, while others require an upfront cost. The ones that pay you are known as net credit strategies, while those that charge you are known as net debt strategies. Net credit strategies pay you your entire reward upfront, whereas net debit strategies make you wait for the maximum reward. Of course, the downside is that net debt strategies cause you to experience your entire loss upfront, as opposed to net credit strategies, which require you to wait and see how it plays out. Take care not to form mental biases against one another. All that matters is the state of the market, not who pays you first or last. Calls on a diagonal spread. A diagonal call is a spread that allows you to generate monthly income from the stock market, while also benefiting from the strengthening or deterioration of stocks. So, how does it work? Purchase a variant that will not expire for several months. In addition, you will sell an option that expires in the previous month. Assume you purchase a 10-month call option for $12. The call is then sold for the first month with a higher realization price for the next 2 months. You can make money. Assume that you sell the first month of 10 months every month. You earn $2 per month and sell a total of $20, which is fantastic given that you paid $12 for calls and sold $20. If everything went well, the profit would be only 8%, or 66% after only 10 months. If the stock falls or you receive a call, you can easily buy back the option you sold or sell the option you bought to reduce your losses. The diagonal call is appealing because it allows you to profit when the stock price rises. Let's say the stock gives you a bullish signal for 1 month and you believe it will rise. You can always decide not to sell the call this month. It provides you with a standard calling option that rises in value with stock prices and is likely to pay you more than if you sold that option in a given month. You must still set a stop loss and manage risk because a diagonal spread can still result in a loss. Having any strategy will significantly improve your chances. Only professional traders should consider using a diagonal call spread. Puts on a diagonal spread. A diagonal put spread comprises a short calendar, spread, and vertical put spreads. As a result, this strategy frequently exhibits characteristics of both spreads. Directionally bearish and short volatility with minimal, zero, or positive time decay are examples of such traits. The resulting time decay will be determined by the expirations and strike price chose. Using options to employ this strategy would help if you took a bearish position in a stock. However, it is critical to begin with a process that has less time decay than a traditional vertical put spread. Short-dated options typically decay faster than long-dated options. As a result, a diagonal put spread has less time decay than a vertical put spread. However, diagonal put spread and vertical put spread are similar in that they use different strike prices to determine directional movement. The maximum gain from a diagonal put spread is the difference between the higher and lower strike, then subtracted from the premium received. The maximum loss will occur when the market goes against your strategy. When the underlying asset's price falls significantly, the value of the two options equals zero. In this case, the upfront premium will result in a loss. You may also encounter a break. Even situation, which is determined by the price of the longer-dated option at the due date of the shorter-dated option. In this case, the break even point is usually somewhere below the strike of the higher strike option. Finally, because the diagonal put strategy necessitates knowledge of both the vertical put spread and the calendar put spread, it is best for the professional options trader to be familiar with both. Strategy using two diagonal options. The double diagonal spread combines a diagonal put spread and a diagonal call spread. And the main goal of creating the spread is to take advantage of time decay and exploit short positions near expiration. This allows a trader to generate profits while also benefiting any long-term positions held in the market. Furthermore, this spread is designed to profit from the underlying stock's neutral price action between the two strike prices of the short calls. As a result, the strategy itself is low risk. Exemplification of a double diagonal spread. Sell 1 XYZ 95 28-day contract, buy 156-day XYZ 100 put at 1.30 buy 156-day XYZ 100 put at $3.80 call at 4.0 and purchase 1 XYZ 110 call 1.50 for more information. 5.0 multiply by 3.80 is equal to net debit 4.0. Specifics of the strategy. The double diagonal strategy is built by selling a short-term strangle spread and purchasing a longer-term straddle. First, we can look at the example provided above to better understand this strategy. We have a straddle and a strangle in our case. We have a 2-month 100 straddle with 56 days to expiration for sale, as well as a strangle strategy. The 95-110 strangle has been sold and has a 28-day or 1-month expiration date. Again, risks and profit potentials are constrained, and the strategy is designed to result in a net loss. It's a sophisticated strategy because the profit potential is limited in monetary terms. Due to the small dollar amounts for profit potential, you must always ensure that you get great prices when opening or closing positions. You must also ensure that you engage in large volume trades or a large number of spreads to keep contract commissions as low as possible. Maximum profit and loss. You will achieve maximum profitability when the underlying stock price equals one of the different strike prices associated with the short strangle. When the underlying stock's price or value equals the short call's strike price, the profit will be exactly equal to the long straddle cost minus the cost of commissions charged and the value of the diagonal spread. We consider this to be the pinnacle of maximum profits. This is because the long call portion of the long straddle will have a total price difference from the short call that is about to expire. Furthermore, when the strangle option passes, the stock price at the strike price corresponds to the short put option. As a result, it is yet another point of maximum profit. It occurs because the long put component of the long straddle gains the most significant price difference with the short put about to expire. Usually, confirming the maximum profit potential would be difficult because other factors at play, such as the long straddle value, are dependent on volatility levels. On the other hand, we take the most risk with this spread position. The real risk that the position exposes a trader to is the same as the total cost of the spread and all commissions due. As a trader, you will lose the entire amount if the strike price of the straddle is equal to the underlying stock. The cost of the straddle position falls almost to zero, resulting in the loss of the entire amount received for the spread. Price of break, even at expiration. The main break Even points are highlighted in this strategy. There is one below the short put strike price and one above the strike price of the short call. As a result, the ideal break even point is the underlying stock price, with the long straddle's value equal to the cost of setting up the spread minus the Strangles value at expiration. In general, predicting the total loss or the value at the Strangles expiration is nearly impossible. This is because this value is dependent on the value of the long straddle, which is a factor of volatility levels. The long straddle position's loss and profit levels are heavily reliant on the estimated value of the short strangle expiration dates. The pricing formula Black-Scholes model is used to evaluate or compute the price. It is a pricing formula that assumes certain assumptions such as volatility of 30%, a total of 28 days or 1 month to expiration, and 0 dividends with a 1% interest rate. Correct market prediction. As a trader or investor, you must make accurate predictions and forecast market behavior. It is critical for several reasons, the most important of which is that you want to get it right and have profitable positions. Ideally, the underlying stock's value should be close to straddle's strike price. Typically, the underlying security's price is found near or at the strike price of the straddle. It is the case when you set up the position, so the forecast for this is neutral price action that occurs between the two strike prices on the short strangle. Information in general. When the forecast shows some price activity between the strike prices of the short strangle, the double diagonal spread strategy is preferred. In this case, the trade-off is that we first establish a double diagonal spread for a net debit, which has a lower profit opportunity than a short strangle. Remember that you must exercise trade discipline and patience to succeed in your trade ventures and maximize profits as a trader. Patience is required because the strategy takes advantage of time decay. At the same time, discipline is necessary because the profit potential of the double diagonal is relatively small. So the cost you pay to enter and exit trades should be kept to a minimum. It would help if you also exercise caution when taking partial profits, as these can significantly impact spread's performance. Long butterflies with calls. Using call options, a long butterfly margin combines a bullish margin strategy and a bearish margin strategy that employs 3 different strike prices for the same underlying asset and expiration date. Puts on a long butterfly. This strategy entails purchasing a call with a strike price equal to the strike price of the underlying stock and selling shares of the underlying stock. It should be noted that one is short an option and long a security. As a result, it is not a position to be taken lightly, as it exposes one to credit risk on a payment made on the short options. This also exposes one to stock risk if the option is out of the money. There are 2 ways to write the long butterfly with puts. 1. Writing calls and selling puts, or 2. Only writing puts and selling calls. When a person only writes puts while owning stocks, this is an iron condor strategy. Iron butterfly. In the iron butterfly strategy, an investor would sell an ATM put and buy an OTM put. At the same time, they would sell an ATM call and buy an OTM call. Both options would be based on the same investment product with the same expiration date. While similar to a butterfly spread, this method employs both puts and calls. This strategy effectively combines the purchase of defensive wings with the sale of an at-some straddle. The configuration can also be interpreted as 2 spreads. It is customary to get the same width in both spreads. The OTM call covers that long infinite downside. The long OTM put protects against the downside. Gains and losses are limited to a small range based on the price levels of the options chosen. Investors prefer this method due to the higher likelihood of a small profit from a non-volatile stock. In the previous P&L graph, notice how the maximum profit is generated when the stocks remain at the call or put ATM strikes. This is because the cumulative net premium earned is the overall benefit. On the other hand, excessive loss occurs when the market rises far above the long call strike or falls far below the long put strike. Butterfly skip strike, W or calls. The long skip strike butterfly spread with calls can be described as a strategy with 4 different call options but 3 distinct parts. We like to take 4 different strike prices into account when it comes to advanced call options. These prices are A, B, C, and D, with D being the highest and A being the lowest. A trader uses a call option strategy to create a long skip strike butterfly spread by purchasing a call option at strike price A. They avoid strike price C and sell 2 call options at strike price B, buy 2 call options at strike price B, and D. Purchase an additional call option at strike price D. All of the strike prices are equidistant, and the expiration dates for the call options are similar. Long skip strike butterfly spread using calls. Purchase 1 XYZ90 calls at 8.0. Sell 2 XYZ100 call options at 4.99.80. At 0.90, purchase 1 XYZ110 calls, 0.90. 0.90 net credit. Example: in the long skip strike butterfly spread with call options example, the trader purchases a 90 call option, then sells 2 calls at 100 before purchasing another call option at 110. The example above clearly shows that this is a sophisticated strategy because the costs are pretty high. In terms of percentage, the maximum risk is relatively high. Among the expenses are numerous commissions that must be paid based on the 3 different strike prices The 3 bid, ask spreads incurred when opening and closing positions are also included in the costs. As a result, traders must ensure that all positions opened or closed are at a reasonable price. Commissions should also be carefully considered because they can negatively impact profits. Profitability is maximized. The maximum profit with this strategy is the difference in price between the initial net credits plus the strike price associated with the 2 short calls, then subtracted from the lowest strike price or the long call option. It is also equivalent to the strategy's lowest strike price minus the strike price associated with 2 short calls minus commissions and the initial net debt. When the underlying stock's price at expiration equals a strike price associated with short calls, you will profit the most. For example, in our previous example, the difference between the strike price of short calls and the lowest strike price is $5, while the net credit at the start is 25 cents but without any commissions. In our case, the total includes commissions and is $5, 25 cents. This strategy carries the highest level of risk. When trading options with this strategy, you can expect the maximum risk to equal the difference in price between the long call or the highest strike price and strike price associated with 2 short calls, minus the maximum profit. Positions are sometimes held for either net debit or a net credit. The situation in the preceding example is a net credit. As a result, the maximum possible loss will occur when the underlying stock's value at expiration equals or exceeds the most significant strike price. In the example above, the difference between the highest strike price and short calls is $10, while the maximum profit is $5, 25 cents without commissions. As a result, in our case, the maximum possible loss is $10 subtract to $5, 25 cents is equal to $4. 75 cents is equal to $4. Butterfly skip strike W or puts. The skip strike butterfly with puts is a three-part advanced options trading strategy with 4 distinct put options. This skip butterfly spread with a put option is created by buying a put option at strike price A, leaving out strike price B, selling 2 put options at strike price C, and finally purchasing another put option at strike price D. This strategy considers 4 different strike prices: A, B, C, and D, with A being the lowest and D being the highest. In this case, the strike prices are evenly spaced from one another, and all of the put options have similar expiration dates. Long skip strike butterfly spread using puts. Purchase 1 XYZ 110 calls at $8.20, 8.20. Sell 2 XYZ 100 call options at 4.79.40. Purchase 1 XYZ 90 calls at 0.90, 0.90, 0.30 net credit. In the preceding example, we see that a single put option with a strike price of $90 is purchased. 2 put options with a strike price of $100 are sold, and a put option with a strike price of $110 is purchased. The $105 strike price sees no action and is thus bypassed. The layout in the position above is designed for a net credit, which means that the maximum risk and maximum profit are limited. We consider this strategy to be advanced because the maximum possible risk is high in percentage terms, and the costs of setting up the spread are also high. Furthermore, the strategy requires numerous commissions to be paid and 3 strike prices and 3 bid-ask spreads. As a result, it is critical to ensure that positions are opened at reasonable prices and paid commissions, as these can be costly. Profits and losses are maximized. When you use this strategy, the maximum benefit you can earn equals the price difference between the initial net credit added to the 2 short puts and the highest strike price, or less than the initial net debit plus all commissions due. You will receive this benefit if the stock price at the time of expiration is equal to the strike price of the actual short puts. In contrast, the maximum loss equals the price difference between the lowest strike price and the 2 short puts minus the total benefit possible. Inverse skip strike butterfly W or calls. This specific option strategy aims to profit when the underlying stock's price rises above the most significant strike price while bearing almost no risk if the underlying stock's price falls below the smallest strike price. On the other hand, profit taking carries the calculated risk of a significant percentage loss if the underlying stock's price trades close to the strike price of long calls. Definition: the short skip strike butterfly spread is another name for the inverse skip strike butterfly with calls. It is a 3-part options trading strategy that includes 4 call options. We assume, with other advanced options strategies, that there are 4 strike prices, A, B, C, and D. With call options, we create the inverse skip strike butterfly strategy by selling a call at strike price D, eliminating strike price A, E, eliminating strike price C, purchasing 2 call options at strike price E, and selling a single call at strike price A. In this case, all strike prices are equally spaced out, and the call options have similar expiration dates. It is an advanced options trading strategy because the maximum possible risk is high, and the associated costs of setting up the system are significant. Based on the 3 strike prices, numerous commissions must be paid. In addition, 3 bid-ask spreads are incurred during position, opening, and closing. As a result, it is prudent to ensure that positions are opened and closed at reasonable prices, maximum profits and losses. As an options trader implementing this strategy, your maximum possible benefit is generally equal to the largest strike price minus total potential risk, less the strike prices of the 2 long calls. There are 2 possible outcomes when a position on the market for a net debit is established. When the underlying stock's price is equal to or higher than the highest strike price, the total profit or benefit available is obtained. However, if the stock price at expiration is the same as the lowest strike price, all calls will expire worthlessly, and the original net debit used to set up the positions will be lost. When you take this position in the market for a net credit, you will profit the most when the underlying stock's price at expiration is greater than or equal to the highest strike price. The maximum possible loss on this trade equals the difference between the strike prices of two long calls and the most negligible strike price added to the original debt incurred when setting up the position, or less the initial credit incurred as commissions paid. Butterfly inverse skip strike W, or puts. The inverse skip strike butterfly spread strategy with put options is a three-component strategy that includes 4 put options. We consider a situation with 4 different strike prices as we do with other complex option strategies. These are strike prices A, B, C, and D, with the highest and D, with the highest and D being the lowest. We make an inverse skip strike butterfly with puts by selling a single strike put option at strike price A, skipping strike price A, skipping strike price B entirely, buying dual puts at strike price C, and finally selling a single put option at strike price D. In this case, the 4 strike prices, A, B, C, and D, are evenly spaced and all of the puts have the same expiration date. Purpose. This advanced options trading strategy seeks to profit from a stock price decline below the lowest strike price while posing almost no risk if the stock price rises to levels far above the highest strike price, simultaneously taking on the risk of more considerable losses if the underlying stock's price is trading near the strike prices of the long puts. Inverse skip. Strike butterfly spread using puts. At 8.20, sell one XYZ 110 put. At $4.50, purchase 2 XYZ 105 put options 9.0. At 0.90.70, sell 1 XYZ 95 put. Net loss 0.10. In the preceding example, we sell a 95 put, avoid the 100 strike price, buy 2 105 puts, and sell a 110 put. As a result, we establish a net debit position. In this case, both profitability and losses are limited, and the setup results in a net debit. We can see that this is an advanced strategy because the costs to set up the position are relatively high, as is the full risk that the trader is exposed to. Please keep in mind that multiple commissions must be paid out. When closing and opening, 3 strike prices necessitate funds, bids, and ask spreads. All commissions per contract should be considered because they can significantly impact profitability. Maximum profits and losses. In this case, you will profit from the difference between the strike prices of the dual long puts and the lowest strike price, minus the maximum risk. In our previous example, the established position is for a net debit. In our case, we profit the most when the stock's price at expiration is less than or equal to the most nominal strike price. In the above scenario, we can calculate the profit as the strike price of long, puts minus the total possible risk of fewer commissions. In our case, the maximum profit is 10.0 subtract to 5.35 is equal to 4.65. Chapter 3. Vertical expansion. When it comes to spread trading, all types of trades fall into 2 categories. Vertical spreads and horizontal spreads are the 2 types of spreads. The names are fancy, but understanding how they work isn't nearly as difficult. These types of trades do raise the level of complexity a little. Spread trades are similar to collar trades in that they take things a step further than covered calls. Collars and covered calls have many advantages, but one major disadvantage is that they pose a risk to the trader. They necessitate a large stock purchase. This is an investment for a covered call, whereas it can be speculative or buy for a collar. Whatever the designation, there is no escaping that long stock investment necessitates a significant investment. What if you want to follow Thala's lead and profit from low capital values? The spread strategies address it. Options allow us to experiment with how price moves. And as you'll see, spread trades encompass taking advantage of a wide range of market behavior. Call spreads on bulls. The bull call spread is the first type of vertical spread we'll look at. It is a bullish trading strategy that performs best in the middle of a trending market. Following that, I'll explain why this is the case. But for the time being, keep in mind that while this is a bullish strategy, it works best when bullishness begins to slow and ranges widen. This can be used in the earlier, more forceful stages of trends, but it isn't the most efficient. In those areas, it's better to buy a call and let the premium rise. The covered call also works well in these situations. In any case, the bull call spread has two legs. You will purchase one call and sell another. As a result, the long call leg of the trade compensates for the short call. Let's take a closer look at the legs. Legs of trade. The long call leg is the first one you should set up. It must be an at the money or slightly out of the money call that you are confident will move into the money soon. The goal is to make the majority of the profit in this trade using this leg. In essence, you are substituting a long call position for the long stock position from the previous two strategies. Establishing a long stock position necessitated some form of protection, which is why the third leg in the collar case was necessary. However, given the investment nature of the covered call, downside protection is moot because you'll be holding onto it for the long term anyway, and the goal is to hold onto your investment regardless of how much it dips, assuming the dip isn't catastrophic. The short call is the second leg of the bull call spread. Again, it is written out of the money at a point where you believe the price will advance to, even if slowly. You want both of these options to expire at least 30 days or more after the trade date. Just like every other strategy we've looked at. Again, it aids in capturing and avoiding the risk of time decay. The bull call spread, like the collar, can be adjusted, and its greatest power lies in a reasonable adjustment. It enables you to remain competitive at a low cost. Adjustments are made based on the market scenario. When bullishness is challenged by bearishness, you should use this to enter with the knowledge that the trend is still strong, but there are some headwinds ahead. Your short call should be placed at a level above the most relevant resistance ahead. When the price breaks through this level, you should move it a few points higher to where the next potential resistance level is, and so on. Alternatively, if you believe that the counter-trend presence is becoming far too strong, you could let the market take you out of the position, closing your long and covering your short bull-put spread. The bull-put spread strategy seeks to profit from the same market conditions as the bull call spread. So, what's the distinction between the two? Aside from the obvious fact that one strategy employs calls and the other employs puts, there are numerous nuances to be aware of. In case you're wondering, the strategies do not contradict one another. Consider it as having two options to pursue, depending on market conditions. If you're wondering how to determine the ideal conditions for each strategy, the first step is to learn about the bull-put spread and how it works. Legs of trade. The bull-put, like the bull call, is a two-leg trade. The first leg entails establishing an out-of-the-money long put position below a strong support level. If something goes wrong, this long put will limit your downside risk. In addition, the long put covers the following leg. It is a short put option written close to or at the money. This leg is the primary profit generator for the trade. I want to point out that the puts have a very different structure and positioning than the calls. By writing an OTM call with a bull call spread, you limited your maximum gain on the trade. You're not capping your gains in this case, but you are restricting your losses with a trade leg. As part of the trade structure in the bull call spread, your maximum loss was automatically capped. You could argue that this is happening here, but it's clear that the strategies used to accomplish this are very different. The next significant difference is in the outcomes of trade entry. The bull call trade is a net debit trade, whereas the bull put trade is a net credit trade. Net debt trades cause you to realize your maximum loss at the time of trade entry. With net credit trades, you make your maximum profit right away. It means you make your maximum profit upon entry, and if everything goes well, your options will continue to exist. Like the bull call spread, the trade can be adjusted based on market conditions. However, because your upside is uncapped, adjustments will be required primarily if the market falls and your puts move into the money. In this case, you must lower the spread and exit your primary position. As a result, the adjustment scenarios in the bull put strategy aren't as diverse as they are in the others we've seen so far. If the trade goes in your favor, you can increase the spread using the same principles you used to set it up in the first place. Spread on bear calls. If you can use call spreads to profit from bullish conditions, you can also benefit from bearish ones. In case you're wondering, you can do this with puts as well, and just like with bullish spreads, you have the option of using call or put spreads to do so. For the time being, let's look at bear call spreads. The bear call spread, like the bull spread, has two legs. As the name implies, you'll be configuring calls as part of this strategy. So now let's take a closer look at the two legs. Legs of trade. A long call position is the first leg you want to establish. The long call is placed above a resistance zone and is the risk, limiting leg. The call is priced out of the money. The greater your risk in the trade, the further away the call is. The second leg to establish is the trade's primary profit generator. You will write as close to the money as possible because it is a short call. The precise placement of this level is difficult because you don't want it to move into the capital. If it does, you'll have to close out both trade legs and accept your maximum loss. Bear call spreads are net credit trades, which means you'll get your entire profit when you enter the profession. As a result, just like the other options trading strategies we've seen so far, you don't need to do anything special to keep the trade going. Of course, you can adjust it as well, but given that this is a net credit trade, there isn't much you can do to change other than work out another spread level if the original business fails. Bear put spread. The bear put spread is the bearish cousin of the bull call. Spread in that it is a net debit trade that seeks to capture more upside in a bearish movement. Hopefully, you've gotten the hang of how vertical spread trades are set up by now. So let's go over how this trade works quickly. It has two legs, just like the other three, a long put and a short put. Long put is established close to the money and is the primary profit generator in this trade. The short put is written out of the money a few levels below and serves as a profit target. Like the bull call spread, this trade seeks to capture as much market movement as possible. As a result, adjustments are crucial in this case. For example, if the market moves close to your short call, you can lower your target and raise your long call leg. This trade follows the same timeline as the others. To avoid or capture as much time decay as possible, you want to establish options at least 30 days before the trade entry date. Using our Tesla example with a market price of $478.15, Let's say we write the Tesla 450 option that expires in a month. We'll make $23.90 in premiums. We can go long on the 475 put at the cost of $36.05. As a result, the net debit on the trade is $12.15, and our maximum loss is $12.15. Our maximum gain is limited to the strike price of the OTM put, which is $25 UTM put, which is 25. Chapter 4. Horizontal distribution. Here are a few horizontal spreads that traders should be aware of. Calendar call spread technique. The spreads we've seen thus far are known as vertical spreads. It refers to how they appear on the option chain, where strike prices are listed one on top of the other. So by shorting one and buying another, you profit from the price difference, hence the term spread. Vertical spreads necessitate trading options with the same expiration month. Calendar spreads involve the purchase and sale of options with different expiration dates. The request, as we will see, the calendar strategy that can significantly affect is a bullish strategy that can significantly affect execution. The calendar call spread is made up of two legs: a current month or a short-term period, a brief message, a short-term or long-term long call. The idea is that while the stock is taking its time to reach the strike price of the longer time frame call, you might as well collect the premium on the short call in the meantime. The long call, which captures the stock's upward movement, is the profit instrument. The longer-term call can be from the current month or a previous cycle. You have a choice. The only factor to consider here is liquidity, as you don't want to be trading in an instrument with a large spread due to low demand or trading volume. You should be fine if your liquidity is adequate and your spreads are soft or manageable. To begin implementing the trade, you will purchase an at or in. The money call to anticipate the upward move. The short call is set at a level that you believe the price will not reach within that time frame. The goal is to profit from the short call's premium and the long call's capital gain. It is as close to a win-win situation as you can get in the markets if this trade works out. Let's see how the math works in the case of Amazon. Assume our long call is from the next month. We'll pay $63.65 for the 1830 call closest to the market price and in the money. Let's say there's a medium-level resistance at 1840 that Amazon will have to work hard to overcome and is unlikely to do so by the end of the month. We earn $36.30 in premium on this call. The cost of entry is equal to long call cost subtracted by short call premium is equal to 63.65 subtract by 36.3 is equal to $27.35 per share. The maximum loss equals the cost of entry. As you might expect, there are numerous scenarios for calculating the maximum gain, as this is dependent on whether the short-term call ever moves into the money. In any case, you must deduct your initial investment from your final profit. Because of their open-ended nature, horizontal spreads differ from vertical spreads. It will take some getting used to, but you will find that they are far more rewarding if your analysis is correct. Insert calendar spread. The horizontal put spread is similar to the call calendar spread concept, but it seeks to profit from a bearish market. The trade structure is also identical to the call. It's just that you'll be purchasing puts rather than calls. As a result, two legs are a part of the deal. The short put leg is placed at a strike price above a medium strength support level. It will have an expiry date that is longer than 30 days but less than the expiry date of the second long put leg. The long put strike price will be the same as the strike price of the short put. The goal is to profit from both short-term neutral behavior and long-term bearishness. The short-term put pays a premium, whereas the long-term put pays capital gains and intrinsic value increases as prices fall. It is also a net debit transaction. Like the call calendar spread, the put spread can be adjusted depending on the type of market behavior observed. The most common adjustment method is to convert it into a vertical spread to take advantage of price behavior. This concludes our examination of horizontal spread trades. As you can see, they're not overly complicated and are far easier to manage and comprehend than vertical spread trades. Spread trades are a step up from collar trades, and they, like the collar, provide decent and consistent rewards when executed correctly. Chapter 5. Managing and rolling option positions. As a trader, you may want to make changes to your positions and trades from time to time. You make these changes and adjustments when you notice market changes that will affect your businesses, but were not anticipated. There are several methods for managing trades, one of which is known as rolling positions. Positions for rolling. Rolling options positions can be done in 3 ways. Depending on your objectives, you can roll forward, down, or even up a place. The term roll, an option, comes from the phrase roll down an option until it has a lower strike price. Traders will need to make changes or adjustments to an existing position from time to time. When a trader closes an existing position and immediately opens another with the same number of contracts, even at lower strike prices, we believe this is a roll-down process. Learning the art of rolling down a position as a trader could be critical to your strategies and determine your performance and profitability. Rolling a position down. Rolling techniques can be used to manage both short and long positions. The same can be said for put and call options. The rolling method will send the option further into the money when it comes to call options. On the other hand, rolling tends to send put options further out of the money. When you are long in the market, you must create a similar order, a sell to close. To perform a roll on procedure, you should expect to fill out an order form with your broker. Some demands would necessitate the inclusion of a BTO, buy to open, STC, or sell to close a position. The goals of rolling down options. There are several reasons why traders frequently roll down positions in option spreads. The first is to stay away from assignments. When a trader rolls down a short put option, the primary goal is to avoid any in-money options being assigned. A trader dealing in naked put writing is frequently a hazardous strategy reserved only for experienced traders. As a result, a trader will roll out a position to avoid assignment in one case. In other cases, a trader will roll a position to make changes that improve its outlook. They do so first when they want to collect profits on a long-standing, particularly one too far in the money. They will be rolled down to positions that are too far in the capital in this case. Traders also use roll-down positions to stop a loss. For example, if a trader's long call options start to lose money, it's a good idea to roll those positions and make adjustments to stop the loss and start making money instead. It is also recommended to use rolling techniques to salvage any remaining value in a losing money situation. The iron condor is rolling. Traders can take advantage of some opportunities, one of which is rolling positions. Certain positions are rolled out to allow for correction time. For example, if you have a position in the market that is not generating profits as it approaches expiration, you can roll it so that it expires a month later. A naked short put, a short straddle, or a short strangle can all cause this. More difficult positions, such as the short iron condor, can also be rolled. A short iron condor is a short premium trade with a well-defined risk. However, moving these positions is much more complex than rolling simpler ones. When trading the iron condor, you might want to start with the short call spread. Do this especially if the underlying stock price is falling and approaching the short put spread. Ideally, a short condor position begins with no risk of exposure because the delta position is zero. However, as the trade takes shape, the stock price will quickly turn bearish, approaching the strike price of the short put. In this case, the delta position will grow, indicating that the trade is generally bullish in terms of direction. One of the best ways to adjust the iron condor is to purchase the old call spread to close the trade. It is the most effective method for reducing the short call spread. Then, we'll offer a new call option with a lower strike price. It will allow for the establishment of new profitable trade. The iron condor adjustments achievements. You will collect more premiums if you perform this rolling process on the iron condor spread. It occurs due to a net credit resulting from call options with a higher strike price. Such opportunities are typically less expensive and result in a net credit. You will also be able to halt and possibly neutralize the directional exposure that the iron condor would have exposed you to. When the call option is rolled down, the iron condor gains positive delta. As a result, rolling ensures that the direct exposure changes direction from bearish to bullish and moves closer to neutral. Short call position rolling down. If you want to roll down a short call position, you must place two orders simultaneously. These orders are sell to open and buy to close. The BC is poised to close its current short position. The STO is then used to open a new temporary job at a lower strike price. Currently, most option brokers allow traders to roll down their positions. On brokerage platforms, direct roll-downs will enable you to fill out orders to roll down a situation that requires additional management techniques. As a result, when you decide to roll down the position, you will log into your brokerage platform. Fill out the necessary rolling forms and roll out your desired position, rolling down a short call position as an example. ABC company stock is currently trading at $50 on the market. You have call options with a strike price of $50 in the market and are hoping for a short pullback. However, ABC shares dropped to $45 a few days later, so you wish for a further price drop. Resultantly, you choose to roll down your call options to the new price of $45 rather than the initial price of $50. By successfully lowering your strike price from $50 to $45, you will have effectively rolled down your position and positioned yourself to earn more money if the stock price continues to fall. Short put position rolling down. Rolling down a put position is almost identical to moving down a short place. This type of options management strategy is a bearish strategy. The steps are essentially the same. As a trader, you will execute both legs simultaneously to reduce the possibility of slippage. Slippage, in this context, refers to the erosion of profit that occurs when the price of the underlying security changes. The new position will be less expensive when rolling a put option because the strike price will be lower. As a result, the new contracts will be cheaper than the old ones. Even so, the outcome could be a credit or a debit to an account. The price difference determines how much credit or debit will be applied to a report. The benefits of rolling down a short put. There are numerous reasons why you would want to roll down a position. One of these is to prevent a buyer from exercising an option contract. Put buyers retain the right to purchase the underlying stock at the stated price, so you could be severely exposed if you have a naked put. Another reason why put options are rolled down or manage to increase the bearish stand of an opportunity with an extended market position is because a long put in the money will lose value, necessitating the need for a rolling procedure. By scrolling position, traders have the opportunity to recoup any losses and earn significantly more profits for their market positions. Holding a long call position in the market can result in a lower strike price if the position is rolled, especially if the underlying security loses value despite the trader's bullish price outlook. As a result, the position will remain in place following the rollout and any potential losses will be avoided. Example of rolling a short put position. Because ABSI's stock is currently trading at $50 in the market, you decide to write a short put option with a strike price of $50. Your outlook on this position is bullish, ensuring that you profit if the price rises. However, the price drops to $45, causing you to lose some of your options. Because the alternative is in the money, you believe it will rise in value over time. You will need to roll down this position to benefit from the expected upward trajectory in the underlying stock price. Short straddle rolling. A short straddle is one of the most profitable trading strategies available today. However, traders must periodically adjust their positions based on market needs and outlook. As a result, it is a technique best left to experienced and advanced traders. Sometimes, intermediate and other traders believe that adjusting a position is complex and challenging. This is not the case because most market positions can be adjusted. A short straddle is occasionally used as part of an iron butterfly. It entails the sale of an option at the money, which consists of a put option and a call option. Consider the following example. In our case, we have the stock ABSI, which is currently trading at $20 per share. As a result, we have a call option with a strike price of $20 and a put option with the same strike price. Both the call and put options are now almost at the money. When we convert this trade into a butterfly, it changes slightly because we buy call options at $25 and then sell options at $15. In this case, we are essentially purchasing options at $5, resulting in a risk-free position. The initial trade at the start now has a $2 credit. If this holds, the break-even point will be somewhere between $18 and $22. We also hope that the trade will move in this direction. We need to do it within the last 3 to 4 weeks before expiration to invert this trade. As the expiration date approaches, we adjust and roll our positions to reduce risks and avoid looming losses. In this case, if the market rallies against our position and the stock rises to $23, we must roll this position. Techniques for rolling and managing straddle positions. The straddle is sometimes regarded as a high-risk strategy. However, the risks are not as severe as they are portrayed. If you are a seasoned trader or a novice, you can learn how to manage the position and avoid this strategy's risks and dangers. This strategy is not as risky or difficult as some may have you believe. Here are a couple of methods for mitigating risks and effectively managing the position. Here are some things to keep in mind when driving your straddle position. 1. Have a vibrant premium. The best and most effective short straddles indeed have a wealthy premium, especially when the positions are near or at the money. 2. Positions that will expire within a month. As a trader, you must create positions that suit your situation. As a result, you should make every effort to close a post as soon as possible. As a result, you must keep a close eye on the prices. Strike prices and current prices are examples of these. Any slight change in the price impacts other variables, such as the time factor. As a result, if there are any unfavorable moves, we can counter them by closing at a profit. 3. You should close positions on both sides as soon as decay begins. It would help if you closed ranks on both sides as soon as the intrinsic value rolls the work and repeats it. When you roll forward your position, you will save it and duplicate it later as may be necessary. It may only be required on one side due to factors such as time decay or price movement. 4. Cover a short call. In some cases, you may need to cover a short put or call if the situation requires it. You will need to use either extended options or stocks to accomplish this, even though long options are more expensive. 5. Get in shape if it's profitable. Exercise can be a beneficial option at times, especially if it pays well. You must ensure that the market value of your position is good. Calendar spread rolling. If you have a calendar spread, changes in the market may cause you to roll the position. If you are to make changes as the place nears its end, certain factors must be considered. Consider the following scenario. ABC has a calendar spread trading the markets at $50. At the moment, the option is in the money. This position is formed by selling a near-term 50 call and buying a deferred month 50 call. After a few weeks, the spread may not be performing as well as expected. As the position nears its end, there is a strong desire to make changes or adjustments. Rolling the position. You have a couple of options at this point. One of them is liquidating the spread by closing the two legs. However, this is not always the best course of action. Instead, you might want to roll the position to improve its market performance. In this context, rolling refers to moving or adjusting an option from its current position to another. When we roll the calendar, we can change the strike price, the expiration date, and sometimes both. Assume that the short calendar spread is about to expire. In this case, you can change the expiration date to a later date. You will keep the same strike price but move the expiration date forward by about 1 month. When you do this, make sure that the new expiration date is not further out in time than the long option. The reason for this is that positive theta benefits you. Near-term options decay faster than other options, such as longer-term options, such as longer-term options. Selecting your strike. In general, there are no rules or regulations that govern the expiration dates of your position after rolling. However, like any other position, there will be some trade-offs in how the pays out. You can choose to move the situation forward for the next 8 days and, if necessary, to the following week. It is possible as long as the date does not exceed the time required to close the spread position. There are a couple of other things you should think about. For example, how far away from the strike price is the underlying stock's value at this point? Remember that changes to the strike price will immediately impact price expectations. You should also find out if any significant events, such as earnings releases, are scheduled to occur during the life of your options. Such major announcements frequently have a substantial impact on implied volatility. As a result, stock prices will be unusually high, particularly for short-term opportunities. However, it may also indicate a price fluctuation. Butterfly on a roll. If you have an iron butterfly position that could lose money, rolling it is preferable to closing it and losing money. Then you can quickly assess the situation. It is preferable to adjust the position in the market's direction. It is best to roll up the iron butterfly, particularly the long put options. These should be rolled up to a higher strike price. There will be a minor debit about the initial credit. The strategy's inherent risk will be reduced, putting it in a better position. Chapter 6. Getting into the mindset of an option trader. Having the proper attitude is critical if you want to be a successful merchant. It can be a distinct advantage. As I previously stated, options are among the most versatile tools in the budgetary world. You must figure out how to use them to your advantage, and one of the skills you must learn in the process is how to gain the perspective of an alternative broker. Strategies for thinking like an option trader. Allow me to enlighten you on a minor mystery. Assume you genuinely want to become a successful broker. In that case, you should not only be exceeding expectations at comprehending the best systems, but you should also have a triumphant attitude. A broad examination can help you sort out your realities. However, your outlook can play a significant role when you are exchanging. It is your mental attitude that will get you far in trading, not your trading methodologies, flawless market examination, or straightforward intelligence. The vast majority of the tenderfoots I've worked with have consistently revealed something very similar to me. They're trying to figure out the proper procedure. However, they're still apprehensive about doing so. Most novices imagine using it, and cash will pour into your bank account once you've mastered the technique. That, however, is not the case. When you've been in the trading scene for a while, you'll realize that trading isn't all about methodologies and numbers, and it can even be stressful at times. There are a large number of merchants just like you who are waiting for their brilliant chance to become a mogul, and they are, for the most part, intelligent and well-educated. They've even planned full confirmation methodologies that are questionable. Nonetheless, you will notice that they, too, lose money from time to time. On the other hand, some merchants can show you a track record of consistent success. Do you know the secret to their consistency? It is their mental outlook. Exchanging brain research is a thing that is heavily researched, Under that framework, a few mental characteristics, views, perspectives, and convictions are concentrated. You should get to know them, and you should be highly successful in the trading scene if you do. The most common market convictions and mentalities include believing that the market is rigged against you. That, however, is a deception that you must discard. It is incorrect and can put you in a bad light. If you continue to think in this manner, you will not carry out your exchanges effectively. Nobody in the market is attempting to undermine your trust, and if you suspect this, you should change your perspective and look at it in a different light. If you continue to bury yourself in such unjustified considerations, you will be unable to correctly assess the open doors that emerge in the market. Remember one thing, the market isn't one-sided in any way. It is unbiased, and there isn't even a speck of doubt about it. The market doesn't care if you're losing or winning. Your trading brain research is responsible for your convictions, and these convictions can become so deeply embedded in your subconscious that they can occasionally drive you into a harmful pattern of self-questioning. In the following section, we will discuss some of the qualities that an alternative dealer should have to succeed. There, you will discover that certainty is, in fact, one of the essential characteristics you should have. Investigate the mindsets of merchants who have lost progressively. You will discover that one thing is fundamental with a large portion of them, and that is there is this bothering self-question that gathers all the pessimism in life. You should understand that if you believe you have misfortune, you are walking in the path of an unavoidable outcome. Thus, you can't win. If you doubt your abilities, you will have difficulties starting trades at the right time or carrying out procedures at the right time. You will not be able to accept the call when you should. It can reduce your benefits and result in a negative salary. Winning traders, on the other hand, do not think that way. They understand how to view market conditions, and they know that their procedures may occasionally fail, or that the exchange may fail even if they did everything correctly. So they don't fall into a pointless cycle of self-pity. Instead, they are sure of themselves and the decisions they make. It indeed isolates them from losing traders, and they never pass up a genuine opportunity that comes their way. Another constant among winning traders is recognizing when an exchange is losing money and is simply a terrible exchange. You might think they're the same thing, but they're not. There is a fundamental difference, and I will reveal it now. Because you lost money, your transaction cannot be labeled as a bad one. That exchange is essentially a loss. The exchange arrangement, to be fortunate or unfortunate, isn't decided based on whether you won or lost it. But what makes a difference is that the potential prize is more fantastic when contrasted with the danger. Furthermore, paying little attention to how the transaction ends will be adequate if the probabilities or chances support you. As a result, If you take a trade and manage it well, regardless of whether you win or lose money, it will be a good trade. Likewise, assume we are considering the opposite, regardless of whether you won cash from the exchange. However, the risk with remunerate proportion was terrible, or if it was not started on excellent standing, regardless of how much benefit you made. In that case, the exchange will be viewed negatively in any case. Trading is a serious, time-consuming endeavor, and many people fail to recognize this before diving in headfirst. When you have a predetermined course set in your mind, and the exchange does not go your way, you will be confronted with a slew of emotions, and the opposite is true when the deal goes your way. Furthermore, traders frequently experience an adrenaline surge along these lines, resulting in an undermining, dangerous, and upsetting situation. Regardless of whether you are a significant part of your life without a care in the world, keeping up that equivalent aura when you enter the trading floor is an influential, extreme errand. The pressure and weight you will feel are unlike anything you have ever felt before. To think like an options trader, you must first learn how to think in probabilities. Indeed, when your hard-earned money is on the line, it may be difficult to think along these lines, but you must learn it. Let us say that a specific methodology claims that when applied to a large number of exchanges, it will result in a 5,050 win or loss ratio. Overall, what else can you do when you have this information nearby and a complete verification of the risks, as well as an exchanging plan in hand? Nothing, because you must stick to your exchanging plan. To put it another way, try not to get too excited about a winning exchange or too depressed about a losing one. To be an effective options trader, you must understand that your transactions will only take place half of the time. When you consider who exchanged from the various exchanges you made, that one exchange is just a tiny part of a grand plan. It will take some investment to maintain this demeanor and way of thinking. However, you must persevere, and at that point, you will have the option to build up the truckloads of control required to be an effective options trader. Characteristics of a successful options trader. We will discuss what characteristics of an options trader make him or her fruitful in this section. There is a reason why some traders outperform others, and I am confident that once you learn about these characteristics, you will be attempting to instill them in yourself. Risk management capability. Everyone will most likely tell you that risk management is essential if you want to be effective. Furthermore, traders will be able to use risk management techniques because they are not precise with risk assessment in any case. Keeping the factor of insecurity in mind, you must understand what an express or verifiable position is. You should also consider what the significant disadvantages of change might be. These are just a few of the questions you should ask yourself. When the risk has been identified, you must be prepared to find a way to mitigate or control it. For example, if you are more into transient trades in the world of alternatives, there will be numerous lost trades that you will go over in a day. Assume you chose to hold your position for the time being, and on the same night, some unfavorable news was released, altering the course of the market. Thus, your wager turned sour. In any case, your risk management system should be adequate enough to control the risk regardless of the circumstances. Enhancement is just one of the procedures that traders use to limit the dangers of the trade. As a result, their trade size is reduced. Another quality that you should have if you want to be a successful options trader is the ability to manage money. Regardless of how much money you have, if you don't manage it, well, it will eventually go down the drain. One of the most common models I can give you is this. Suppose a trader used 90s of his capital on a single trade and the trade reverses, causing him to lose almost all of his money. Have self-control. Having a valid order will help you advance in your options trading career. Whatever the case may be, what exactly does it mean to be disciplined? It implies that you have done an adequate amount of research, effectively identified the market opportunities that can work in your favor, set up exchange the correct way, structure objectives, Utilize the proper methodology and have a way-out system. Do you know when you're lacking in discipline? You don't work on anything original. Instead, you follow the crowd. If someone gives you a tip, try not to be too confident in it if you haven't completed your examination. When you make a mistake, it is your fault, not the person who gave you the tip. If you had carried out your investigation, you would have discovered what was wrong with the information. That is why having a free system is so crucial for everyone. Although a few traders have completed training in this field, many successful traders did not read about options trading and are still well known. In this way, it is entirely up to you whether you need to pursue your degree or not. However, to pay little heed to that, having a thorough understanding of how the market works is critical for everyone. If you do a Google search on the most proficient method to make a lot of money in options trading and think you've figured it all out, you're mistaken. You must delve into the nuances and learn everything you can about the market and its activities. The ability to control one's emotions. Controlling your emotions is an essential aspect of trading brain research. Controlling your emotions does not only apply when everything is going wrong. It also applies when everything is going well, and you are more likely to make mistakes because you are so excited about your success. If you ask most of the market's amateurs, they will all tell you the same thing. They made more mistakes when they were excited and optimistic about success. Regardless of how many series of wins you have, you must remain grounded and avoid becoming arrogant. If any of your exchanges turn out to be incorrect, you should admit the mistake and then withdraw. Never become overly attached to a single stock. Otherwise, it will destroy you. First and foremost, stick to the standards you set for yourself and don't deviate from your path because you're passionate about it. Be an involved learner. The Chicago Board of Trade has stated that 90% of traders will fail. However, the important thing here is to learn from your mistakes and blunders rather than remain unaware of them. Practice and more practice will help you advance beyond others, and in order to do so, you must comprehend why those misfortunes occurred so that you can amend your exchange from the following exchange onward. The market is never stagnant and is constantly evolving. As a result, you must also grow with it by being a functioning student. Maintain a record of your trades. Influential merchants keep track of their transactions in a diary or another place. Do you understand why? So that if a similar situation arises in the future, you can recall what you did and possibly apply the system again. Every one of your completed trades contains a wealth of information, particularly if you can remember it and use it to your future trades. It will put all of your chances in your favor. How do you know when it's time to buy or sell? Importantly, you must buy or sell your options at the right time. Otherwise, you will most likely miss out on good profits. As a result, here are a few factors to consider that will help you make your decision. Is the option reasonably priced or overpriced? I understand what you're thinking. You're wondering how you can determine whether a particular option is overpriced or underpriced. To find it, you must first decide on its natural worth. It is not the same as doing it based on values, and the model used based on choices is known as the Black and Scholes model. With this model, you will be able to discover your innate worth. I'm not going to get into the equation's insights because you'll get there once you get to the trading stage. You must understand that an option is classified as overpriced when its cost exceeds its characteristic worth, and such opportunities must be sold. In reality, however, an option will be ordered as undervalued if its cost is less than the characteristic worth, and such a choice must be a branch. Examine the volatility. Unpredictability plays a significant role in determining whether you should buy or sell alternatives, and you will see how. One such factor that can profit both put and call options is unpredictability. On the plus side, the alternative becomes significantly more significant, and on the minus side, there is a limited risk. In simpler terms, if instability grows, the estimation of alternative increments becomes excessively independent of how the stock's price is at a similar point. As a result, when such an event occurs, you should buy options and sell them when you notice a decrease in unpredictability. The occurrence of significant events. It is always advised that before any significant events or geopolitical issues arise, you should not sell your options but rather acquire them. Consider what would have happened if you had sold your put options prior to the Greek emergency. If you buy the possibilities instead of selling them, you will only lose the premium you paid. However, if you decide to sell them, there is a chance that your entire capital will be cleared out. Are you taking a defensive or a positive stance? Your decision to sell or buy an option will be heavily influenced by your opinion of the record or stock. Let me clarify the significance of the 2 points of view so that we are all on the same page. When you believe that a specific stock is going to go down or definitively go up, that is when you have reached an agreement. If your viewpoint is valid, you can either buy a put option or a call option, depending on the situation. However, if you have a defensive view, you should sell the opportunity at this point. Assume, for example, that stock will not rise above $10. At that point, selling your $12 call option on this stock would be a better option than purchasing. Date of expiration. The termination date, or the time remaining to expiry, is a significant factor in almost every option that assumes a job. As I previously stated, unlike stocks, each option agreement has a fixed expiry date before it must be worked out. Otherwise, it becomes pointless. In any case, the time factor works in favor of vendors and against purchasers. The time rot is very steady at first. However, as the time and expiry date begin to diminish, the corrosion accelerates. In layman's terms, the options estimation falls faster. Things being what they are, getting opportunities near their expiration date is anything but a wise decision, right? It is a critical decision whether to buy or sell options, but whatever decision you make, you must think about it thoroughly. Chapter 7. How to maximize profits with options trading. Now, let's look at some of the steps you can take to maximize your profits with options. Options are a great way to make money because they allow you to reduce your exposure and risk while increasing the number of profits you can make. Some of the tips you can use to help maximize your profits while trading options are as follows. Tip 1. You can profit regardless of the market situation. One of the first things you'll notice when working in the options market is that you can profit from any market situation when you use options. The majority of the strategies that work with this investment vehicle combine various option positions. They may even use the stock's underlying function at times. As a result, you can employ a variety of trading strategies or collaborate with a few to profit, regardless of market conditions. When you enter the market with options, you always have the potential to make huge profits while minimizing your risk. Ordinary stock trading is less reliable and carries a lot more risk. The most important aspects of options trading are knowing when to enter and exit a trade. Knowing when and how to exit will help you keep your losses to a minimum while increasing your profits to the greatest extent possible. Options strategies are widely regarded as one of the most adaptable in the financial market. They will provide investors and traders with numerous profit-making opportunities while posing a low level of risk and exposure. It is one of the main reasons why many investors prefer to take their time and invest in options rather than other asset classes. Because you can profit regardless of what happens in the market, it gives you a lot of flexibility when working with options. However, it is possible that you will need to learn a lot more strategies than usual. Learn a few plans for a rising market, a stagnant market, and a downturn. It will ensure that you are ready to go regardless of where the market is headed. While profiting in any market is excellent, and can open up many new opportunities to make money when compared to simply investing in the stock market, it does make things a little more challenging to work with. To begin, you must understand where the market is headed. Know which strategies work for the various market directions and be prepared to switch back and forth depending on how the market performs. Tip 2. Make the most of the profitability of option volatility. Options are similar to stocks in some ways, but they are not identical. And one of the key differences is the time limit. Stocks can be held for as little or as long as you want, whereas options have an expiration date. It means that the amount of time you have to make the trade is limited. And as a trader, missing this window will be a costly mistake that you should avoid at all costs. If you pass up this opportunity, it may be a long time before you see it again. It is for this reason that using a long-term strategy when trading options is never a good idea. Strategies such as working with the average down are regarded as poor choices for options trading because they do not occur within the appropriate time frame. Also, keep an eye out for margin requirements. Depending on what these are, they may have a significant impact on the number of funds you can invest in. There are also times when a favorable price is influenced by a combination of factors. For example, the price of the asset you choose may rise, which is generally regarded as a good thing. However, any accrued benefits may be eroded due to other factors such as volatility, time decay, and dividend payment. Because of these constraints, you must learn how to implement some of the different profit-taking strategies. Third tip, always use a profit-taking stop loss. The next piece of advice is to set up a profit-taking stop loss. You can set a stop loss at about 5%. If the trailing target is $95, it means you want it to reach a price of $100. If the upward trend continues and the price reaches $120, the trailing target, assuming the previous 5%, will be $114. And it would continue to rise from there, depending on how much profit you want to make in the process. Assume that the price is about to begin to fall. When this occurs, you must exit and collect your profits at this level or the trailing target you set. It ensures that you get some protection as the price rises, and then you exit the trade as soon as the price begins to fall. It is important to remember that stop-loss levels should never be too high or too low. In most cases, if they are too small, you will be forced to leave the market too soon. However, if they are too high, it will be impossible to profit. Tip 4. Sell covered call options in place of long positions. Selling options is a very profitable way to generate income. Depending on the amount of risk you take and the types of trades you choose to make, you could easily earn more than 2% per month. However, this is not the only way to become wealthy in the market. You can also go with something called a naked put and sell these. It is comparable to selling stocks or shares that you do not own. You will be able to free up some of your time by selling a naked put option. For example, stock trading gives you the opportunity to sell stocks of shares that you do not already own, allowing you to profit. Furthermore, it will liberate your capital, allowing you to invest or trade with it indefinitely. To make this method work, choose stocks that you already know well or that you wouldn't mind owning. This way, you'll be aware of any significant changes in the stock, and you'll be able to make changes to your investment strategy before the market turns and erodes your profits. Of course, there is still some hedging involved with this options trading method, so keep an eye out for that. Tip 5. Select the appropriate strategy. Often, the one you choose will lead you to the suitable options to sell. Some options trading strategies will perform well in a downturn, while others will perform best in an upturn, and still others will perform well when the market is more stagnant. When you select a strategy, you will choose the best options that correspond to that strategy. That being said, there are a few guidelines you can learn to follow when it comes time to buy an option for trading. Following these guidelines will make it easier to identify the possibilities from which you should profit. Among the policies are the following. Determine whether the market is in a bullish or bearish trend. Also, determine whether you are strongly bullish or only mildly bullish. It can make a difference in how the market performs and which assets you want to work with. Consider how volatile the market is right now and how it may affect your options trading strategy. You can also consider the current state of the market. Is the market currently calm, or do you see a lot of volatility? If it is not very high, you should purchase call options based on the underlying stock, which are typically considered to be relatively inexpensive. Think about the strike price and expiration date of any options you want to trade. If you only have a few shares at the moment, this may be the best time to buy more of the stock or asset. The overall goal of working with the options trading market is to maximize your profit. Nobody enters the market or any other type of investment with the intention of losing money. However, if you follow some of the above tips, you will maximize your profits and see some fantastic results. Chapter 8. Financial Leverage from Experts. While it should come as no surprise that you will need to gather as much data as possible to make the best trades, regardless of the market you are working in, it is essential to remember that if you don't use it correctly, it will all be for naughty. There are two ways to make the most of any data you collect. The first is through technical analysis, and the second is through fundamental analysis. As a general rule, you'll find it helpful to begin with fundamental analysis before moving on to technical analysis as need. To understand the distinction between the two, consider technical analysis in terms of chart analysis. Basic research, on the other hand, focuses on specific factors based on the underlying asset for the market in question. The central tenet of fundamental analysis is that related details can tell the entire story about a market. Technical analysis, on the other hand, believes that the only necessary details are those pertaining to the current price. As a result, fundamental analysis is generally thought to be easier to master than concepts that are less directly related to understanding market movement. Meanwhile, technical analysis is usually faster because critical fundamental analysis data is frequently made public on a strict and limited schedule, sometimes only a few times a year, implying that the availability of specific data for updating is somewhat limited. Fundamental rules of analysis. When it comes to trading successfully, the best time to use fundamental analysis is when you want to gain a broad understanding of the current state of the market and how that relates to the state of things shortly. Whatever market you consider, the end goal is the same. Find the most influential trade for your target time. To begin analyzing the fundamentals, you must first establish a baseline regarding the company's overall performance. To produce the most valuable results, you must first collect information about the company in question as well as the related industry as a whole. When gathering macro data, keep in mind that no market operates in a vacuum, which means the reasons for specific market movements can be much more complex than they appear at first. Fundamental analysis works because of the stock market's proclivity for patterns, which means that tracing a specific market move back to its origin will give you a better idea of what to watch in the future. Furthermore, every industry goes through phases in which their penny stocks are worth more or less overall based on general popularity. If the industry produces a large number of popular penny stocks, overall volatility will be low while liquidity will be high. Finally, consider global issues. Once you have a general understanding of the current phase you are dealing with, the next thing you will want to consider is anything going on in the larger world that will affect the type of businesses you prefer in your penny stocks. Not being prepared for major paradigm shifts, especially in penny stocks where new companies come and go so quickly, means missing out on massive profits and should be avoided at all costs. To avoid being caught off guard by news you could have predicted, it is critical to look beyond the apparent issues dominating the 24-hour news cycle and delve deeper into the comings and goings of the nations that will most directly affect your specific subsection of penny stocks. anything in technology is an essential global phenomenon to which you should pay close attention. Major paradigm shifts, such as the adoption of smartphones or the current move toward electric vehicles, can cause significant paradigm shifts. Put everything together. Once you have a good idea of what the market should look like and what might be on the horizon, the next step is to compare what has been and what might be the current state of the market. It will provide you with a realistic idea of what other investors will do if certain events occur in the same way they have in the past. Furthermore, you will be able to use these details to identify underlying assets that are currently on the verge of generating the type of movement you require for binary options trading when it is nearing the end of a post-bust period or the end of a post-boom period. Depending on whether you are going to place a call or a put, is the best time to get on board with a new underlying asset. In these scenarios, you will have the most access to the market's freedom, and, as a result, the most overall allowable risk in any market. Remember that the amount of risk that you can successfully handle without increasing your chances of failure will begin to decrease as soon as the boom or bust phase begins in earnest. So it is critical to get in as quickly as possible if you hope to truly maximize your profits. Finally, learn about the relative strength of each trade. When an underlying asset is in a bull market, the power of its underlying fundamentals will determine how other investors will behave in binary options trading. Keeping this in mind, it stands to reason that the earlier an underlying asset enters a specific boom phase, the stronger the market surrounding it will be. When it comes to fundamental analysis, remember that what an underlying asset looks like now isn't nearly as important as what it's likely to look like in the future. Keeping an eye on the past is the best way to determine those details. Fundamental quantitative analysis, the sheer volume of data and the large number of varying numbers found in the average company's financial statements can be intimidating and befuddling for conscientious investors who are delving into them for the first time. However, once you've mastered them, you'll quickly discover that they're a gold mine of information for determining how likely a company is to continue producing reliable dividends in the future. A company's financial statements, at their most basic, disclose information about its financial performance over a specific time period. Financial statements, as opposed to qualitative concepts, provide cold, hard facts about a rarely open company for interpretation. Words of importance: balance sheet. A balance sheet is a detailed record of a company's equity, liabilities, and assets at a given point in time. A balance sheet depicts the financial structure of a company by dividing its equity by combining shareholders and weaknesses to determine its current assets. In this case, assets represent the resources that the company actively controls at any given time. Buildings, machinery, inventory, cash, and other items may be included. It will also display the total value of any financing used to generate those assets. Equity or liabilities can be used to fund a project. Liabilities include debt that must be repaid eventually, whereas equity in this case refers to the total amount of money invested in the business by its owners. It may also include profits from previous years, which are referred to collectively as retained earnings. Profit and loss statement. While the balance sheet is a snapshot of the company's fundamental economic aspects, the income statement focuses solely on its performance over a specific time period. The length of time considered by an income statement is not limited, so you could see them generated month to month or even day to day. However, the most common type used by public companies is either annual or quarterly. Income statements detail the profit, expenses, and revenues generated by a company over a specific time period. Statement of cash flows. The cash flow statement frequently shows all of the company's cash outflows and inflows over a given period. The cash flow statement often focuses on operating cash flow, which is the cash generated by day-to-day business operations. It will, however, include any money available from investing, which is frequently used to invest in assets, as well as any cash generated by long-term asset sales or the sale of a secondary business that the company previously owned. Cash as a result of financing is another term for money paid off or received as a result of issuing or borrowing funds. Cash flow statements are important because they are often more difficult for businesses to manipulate than other financial documents. For example, while accountants can easily manage earnings, it is much more difficult to pretend to have access to cash in a bank when there is none. As a result, many astute investors regard the cash flow statement as the most reliable way to assess a company's performance. Discovering the specifics. While locating all of the disparate financial statements on the company in which you are interested in purchasing stock can be time-consuming, the Securities and Exchange Commission requires all publicly traded companies to submit regular filings outlining all of their financial activities, including a variety of different financial statements. It also includes information such as managerial discussions, auditor reports, deep dives into operations and future prospects, and many other things. All of these details can be found in the 10-K filing that each company is required to file every year, as well as the 10-Q filing that they must send out once a quarter. Both types of documents are available online at the corporate and SEC websites. Because the version that appears on the corporate website does not have to be complete, it is best to go to SEC.gov and learn about the electronic data gathering, analysis, and retrieval system, which automates the process of indexing, validating, collecting, forwarding, and accepting submissions. Because the system was designed in the mid-1990s, it is necessary to devote some time to learning the process, as it is more cumbersome than 20 years of user interface advancements would have led you to expect. Fundamental analysis qualitative. Name recognition, patents, and quality of board members are examples of qualitative factors. Qualitative elements include model of business. When you hear about a company that might be worth following up on, the first thing you should do is look into its business model, which is essentially a generalization of how it makes money. These kinds of details are usually available on the company's website or in its 10-K filing. Advantage in marketplace. It is also critical to consider the various competitive advantages that the company in question may have over its competitors. Companies that will be successful in the long run will always have a competitive advantage in one of two ways. They can improve their operational effectiveness or their strategic positioning. The term operational effectiveness refers to doing the same things as the competition, but more efficiently and effectively. When a company gains an advantage by doing something that no one else is doing, this is referred to as strategic positioning. Alterations to the company. To properly narrow your search, you will typically find the most reliable results when it comes to companies that have recently seen significant changes to their corporate structure, as these types of changes are more likely to precede events that will see the company jump to the next level. The specifics of what occurred in this case are nearly as important as the fact that, statistically speaking, 95% of companies that experience this type of expansion began with a significant shift in the status quo. Chapter 9. Reliable Profit Capture Exit Strategies. How many times have you lost money on unrealized gains? If this happens to you, you may need to learn how to consistently implement your exit strategy. Never make a profit at a loss, as the old adage goes. This simple rule is always essential for successful trading. Unless and until you always use a reliable exit strategy, your trading success will be far from what it could or should be. Your profitability is erratic. You improve your chances of beating yourself. It can result in a more significant loss, dissatisfaction with trading performance, and even distrust. Why do you need a plan of exit? Several of your trades will be profitable if you consistently apply your exit strategy to each transaction. your winnings are typically more significant. You improve your chances of success over time, and your losses are generally more minor when you lose a trade. Emotions will no longer cloud your judgment, and you will never allow unrealized gains to turn into losses. You must have complete confidence in your exit strategy, because if you trust my exit strategy, it is psychologically simple to implement it automatically in every transaction. As a result, you should never have any doubt, confusion, or hesitation. The transaction has 3 stages. Each transaction is divided into 3 stages: input, knowledge, and exit. There is an exit strategy for each step. Your trade will be more successful if you allow the profit to run while limiting the losses. It means that you should always consider your prognosis before opening a position. If your prediction proves to be incorrect, close your situation immediately. What's left should be abandoned. You have no reason to remain in this store. A stop-loss order determines when a trade must be closed. I employ 3 different stop-loss strategies, one for each stage of my businesses. Set the loss of input loss before opening the position. Set the loss of rear break if the trade moves in my favor, and after I reach my waypoint, I will profit, stop loss, gain profit. I always set a stop loss before opening a position. On the daily stock price chart of bull trades, I put it 1% below the recent strong swing. If the stock achieves an everyday closing price during this period of income loss, I will leave in the morning. Unfortunately, my prediction was incorrect. Stocks are falling rather than rising. If the stock rises as expected and does not stop when entering at the entry level, I will increase the rear stop losses by 1% in the event of subsequent losses due to fluctuations. While the ratchet effect reduces potential losses and blocks profits, my stops are also based on the daily closing price. The following day, each regular closing price is activated in the event of another stop loss. Your company's goal. You should also estimate where you believe the stock price will go in the future. You must plan ahead of time how you will close your trade in order to maximize your profit when you reach your waypoint. When the transaction comes your predetermined point, implement your exit strategy with zeal. It is not a good idea to end a trade when you reach your destination on the route. It is better to stay in the business as long as it is profitable. However, you should stop trading as soon as you notice that the market is posing an unrealized risk of your unrealized profits. When I reach my waypoints, I use stricter termination criteria to make activating the output easier. Stocks are reduced rather than increased after startup. I'll just stay in the box as long as the stock market continues to rise. Every day, I transfer my excess to the intraday layer. I will leave as soon as the shares are trading below yesterday's low. Stocks fell by definition. At this point, the population is more likely to shrink than grow. Correct your excessive losses. The market offers a lot of advice that puts your unrealized profit at risk. Profit losses no longer pose a threat to unrealized gains. To make a profit, you can use one or more of the following criteria. You can stop trading as soon as the share price turns in your favor, as soon as the trend line breaks, as soon as price support is broken, or as soon as a simple moving average breaks. Each of these terms indicates that your trade is likely to begin and that your unrealized gains are at risk. If all of these criteria are met, you must permanently close the course. Aside from this standard procedure, I will be able to override other stop-loss strategies based on the pricing model: indices, options, and time. So in the bear, I'm just concerned with the process. You can manage your exit strategy in this manner. As a result, you can increase profits while decreasing losses. This should prevent you from turning unrealized gains into losses. The identification of exits falls under the category of trading systems. Entrances must be located in meaningful places on the market. determined by support and resistance. However, before beginning a transaction, it is always necessary to decide on the initial output. Then you must exit the trade when the stop asks you to. 1. In order to lose the first stop, make the following order. If the trade goes wrong at the start of the operation, the first step is to get you out of it. Many systems have both a first and a second stop, but the second stop is not always known until certain conditions are met. The ideal first stop should also allow for breathing space, but not so much that the trader takes excessive risk. Use a loss, stopping strategy based on the market price, critical levels of support, or some level of retracement. 2. Another common exit strategy is the break-even point. When the market moves in your favor, the loss of clues can be shifted to the entry price, and this is one way to secure a winning trade before using reverse cessation strategies. This method is widely used and popular because it reduces trading anxiety. 3. Use the backstop to profit when the market moves in traders' favor. There are numerous reversal strategies available. A basic exit strategy consists of 2 steps. The levels to which the trader must shift his stop loss to secure earnings are determined by the highest or lowest of the last 2 measures. This strategy is ideal for trading within a day or when a trader anticipates the market entering a consolidation phase. 4. Do not move the stop for emotional reasons. It's the rule, and I'd like to comment on it with exit strategies because it's the most important rule to follow. Emotions are excluded when acting and sticking to a plan. This rule ensures that exit strategies serve their purpose and that traders benefit from them. 5. Use a timeout. Most trading systems would halt trade before a significant economic event, such as the payment of non-agricultural farms. To prevent market fluctuations, a time stop is used to stop trading prior to this reporting event. As a result, the risk of market volatility decreases as time passes. When you enter any type of trade, you must first ensure that your exit strategy is planned, regardless of whether the business ends in a winner or a loser. This is because you understand that managing your trading and having a good exit strategy are 2 of the most important aspects of trading in the market. Options trading, like any other type of trading, necessitates meticulous preparation and execution. Every day you have some kind of market participation, in my opinion. We're all in this together. As a trader, you can quickly enter and exit the market with the click of a button. But once you're inside, do you have a clear plan for getting out? Trading is similar to a business, in that it necessitates planning and strategies that demonstrate your desire to expand your business. A solid business plan is required for successful trading. Blinding in the market is simply a sign that you are speculating or rushing to see which way the market is going. You need the right approach and an even better exit strategy, just like any other plan. What do you do if your business fails? Can you salvage what's left, or will you simply let go when you believe the market will recover? Most of us can take advantage of the first opportunity to save what we can and propose a strategy to improve our current situation. It may be too late at that point because all planning must take place prior to beginning a trade. You should have a good exit strategy that complements your trading strategy and timing, depending on the trade, because you do not have time to think about your termination in short time frames such as 15 minutes. An exit strategy must be planned before executing a trade. You have much more time if you have one. 4 hours, and you can still develop your exit strategy. These professionals in professional trading always have an entry and exit strategy in mind after analyzing market conditions and only need to follow their plan. They emphasize the importance of balanced trade and already favored entry or exit. They regard both as equally important. I am astounded by the outcome as most beginners who believe that you can achieve an individual winner with all of the exact entry points. I came across several safe winners based on precise entry points, but it turned out that I was a massive loser due to my inability to exit at the right time. So keep it in mind whenever you trade with a clear exit strategy. Chapter 10. Money Management and Protection of Capital. Our mindset gives you an excellent chance to hedge against risk in your trades, but it is not the only way to protect yourself. You must also ensure that you are protecting yourself against market risks in order to take advantage of all of the tools available to assist you in succeeding. When it comes to trading, you can never be too cautious, and you should always use every technique available to protect yourself from market risks. Diversification provides protection. Diversifying your portfolio is one of the best ways to protect yourself when trading. Diversifying your portfolio entails putting your money into a variety of different trade deals in order to invest in a variety of other areas. Furthermore, diversification protects you against risk by reducing the possibility of total losses. In this case, if one of your trades underperforms, another is likely to outperform it and compensate for the loss. As a result, as long as you do your best research on every single trade and trade with confidence, you are likely to see success in many of your businesses if you use this strategy, and the losses you do experience will be far less severe. People who want to make a significant profit from trading almost always invest in multiple transactions at the same time to ensure their success. This increases your chances of making a profit. When it comes to diversification, there are three options. The first method is to become involved in a number of trades that are all reasonably similar, such as participating in a number of different options trades. If you are new to trading, you should start with this diversification strategy and master trading options before moving on to another investment or trading form. This way, you can build your confidence and skill in prospects before attempting a new trading strategy. Diversifying with non-correlating assets and diversifying your risk category are the other two types of diversification you can do with trades. Both of these will assist you in limiting your risk while also improving your money management skills, allowing you to become a competent and successful trader. Increasing your risk category diversification. Diversifying your risk category is another way you can and should diversify your portfolio. When it comes to trading, there are three risk categories to choose from: conservative, moderate, and high. Traditional trades allow you to guarantee a profit from your gains. However, the insured amount is often minimal and has little room for growth. Moderate trades carry a higher risk, but they also yield higher profits in the long run. If you trade moderately, a robust trading strategy can help you succeed in those trades, increasing your chances of profiting. High-risk category trades have a high failure rate, but they can yield massive profits if they grow. Because of the increased risk, these are the most stressful investments to make, but the rewards can be enormous if they succeed. In general, each trader has a risk category that they tend to stick to for the majority of their trades. This category, however, is likely to fluctuate as they get older. The older you get, the more you'll need to have your profits available to use, and the less time you'll have to recover from any losses you incur in your trades. As a result, it is recommended that you use your age to help you determine what risk category you should be trading in when making trades. Subtraction of your age from 100 is the simplest way to determine your category. Your age should be represented by the percentage of your funds invested in conservative investments, with the remainder free to be invested in moderate or high-risk investments. Ideally, you should use this rule to determine which percentage of your money should be invested in medium risk and which in high risk, so that your money is always invested in an age-appropriate manner. For example, if you are 25, you should invest 25% of your total investment capital in conservative investments. The remaining 25% of your investment capital should then be invested in average assets, with the remaining 75% invested in high-risk investments. If you are 60, You should invest 60% of your total investment capital in conservative profiles and 60% of your remaining investment capital in moderate investments. The remainder can be used to make high-risk investments. Of course, you can always modify your chosen strategy based on your perception of your needs and the level of risk you are willing to accept. But using this as a guideline is a great way to ensure that you are managing your money correctly. This way, you can maximize your profits while also ensuring that the capital you require is available at any time in your life. Diversification with non-corresponding assets. When you first start trading options, you can implement this strategy almost immediately. The key to this diversification is that the underlying assets are distinct from all of your trades. Some of your transactions, for example, may involve assets such as bonds and ETFs, while others may include commodities and currencies. By changing the underlying assets being traded, you protect yourself from fluctuations in the specific stock you are investing in, as well as the industry in which it is a part. In this case, even if the industry as a whole suffers, you are not at risk of having every single trade deal you have made suffer as a result. Instead, you can be confident that a significant portion of your portfolio is unaffected by the fluctuation and you have no reason to panic. If you want to take it a step further, after you have gained confidence in options, you can begin to diversify your trading style by investing some of your funds elsewhere. I won't go into detail because it isn't relevant to swing trading with options. However, I understand that it can protect your overall investment portfolio while also giving you the most earning potential with your capital. The risk account of 5%. Some people believe that a trade deal should only include the capital required to purchase the trade, including the cost per share and the commissions paid to the brokerage to complete the transaction. While it is true that this is the only money required to begin a trade, it is not the only amount that you should set aside for a business. If you want to effectively manage your money and hedge against risk, you should always put 5% of your total investment amount into a risk account. This account ensures that you have enough capital to recover losses if they occur, allowing you to continue trading. Without it, you may discover that some of your losses have disastrous consequences for your bottom line and significantly reduce the number of trades you can afford to engage in actively, thereby reducing your profitability. Maintaining a risk account with 5% of your total investment capital, or more if you are engaging in riskier trades, will ensure that you are protected and can continue to trade even if you incur a loss. The 2 rule of money management. Aside from ensuring that your portfolio is diverse with various investments and risk categories, you should also ensure that you manage your capital with each trade you make. Ideally, you should never invest more than 2% of your total investment capital in a single transaction. So, if you have $5,000 to invest, you should never put more than $100 into a single trade. It ensures that you diversify your portfolio sufficiently to protect yourself from risks while increasing your chances of profiting from each trade. In contrast, if you invest more than 2% of your investment capital in any given trouble, you expose yourself to massive losses that can devastate your portfolio and investments. Realizing this rule and implementing it in your trading portfolio may appear overwhelming at first, especially if you are new to trading. You may be concerned that you will not be able to effectively manage all 50 trades, which is a reasonable concern when starting out as a trader. Understand that enacting this rule does not obligate you to start in 50 different businesses all at once, effectively overwhelming yourself with the task of managing them all. Instead, you can begin by managing just 1 trade, then progress to working 3, 5 works, and so on until all of your investment capital has been sunk into various investments. Gradually increasing the number of trades you participate in will not only help you become accustomed to managing all of these trades, but it will also keep you from becoming fearful or overwhelmed and making emotional trade deals. It's beautiful to start small and work your way up as your confidence grows, as this can be a powerful opportunity to boost your trading success. Profits are retained at a 30% rate. When you first start trading, you must always keep a percentage of the profits from each trade. It may appear to be a good idea to reinvest all of your earnings in your businesses in order to increase your earnings, but trust me when I say this is not the best option. Investing all of your profits back into trades can make trading appear futile and can work against your desire to remain committed and persistent with all of your businesses. With all of the effort you are putting into making those profits happen, it may begin to feel pointless if you are not at least occasionally rewarding yourself by cashing out on some of them so that you can experience the tangible benefits. If you are trading to increase your capital rather than to replace your income, you should only keep 25% of your overall profits in your trades. Instead, this capital should be used to achieve the goal you set before starting to invest, such as saving for a down payment on a house or paying off some debt. This way, you're accomplishing your goal with trading while continually investing more in your trades to do even more in the future. If you are trading with the intention of completely replacing your income, you should use the right strategy to get there so that you can comfortably leave your job while still being able to afford the cost of living. In this case, you should cash out about 30% of your overall profits from each trade and apply it to your living expenses. You should hold off on quitting your job until you can reasonably live off of 30% of your profits so that you do not leave before you can comfortably support yourself. Ideally, you should put that 30% in a savings account as soon as possible so that it can be quickly accessed if you need it after you quit your job. You should also aim to have 30% of your profits cover your living expenses for at least 3 months before leaving to ensure that you can consistently produce a strong enough income to keep yourself afloat after you quit your job. When it comes to investing in the stock market, you should never cash out more than 30% of your profits from trades. While you may want to make adjustments as needed, you should not make it a habit because it can seriously eat into your bottom line. When it comes to trading, profits are used to help you make even more enormous profits by hedging you against losses in other trades. If everything goes as planned, you will have far more money to invest, and the 30% you cash out on will grow every time. If not, that profit margin will cover any losses in a bad trade deal, effectively protecting you financially from the risk. Chapter 11. Learning to read an options chart. Many traders and investors have discovered the numerous advantages of options trading. Many more people want to become wealthy through option trading. As a result, trading volumes at options exchanges have steadily increased over the years. More traders and investors are now able to participate in options trading thanks to data dissemination and electronic trading. To build wealth and earn a consistent income from trading, you must first understand the trading process, terminology, and other helpful features. Options are used by some investors and traders to speculate on price direction. Others use them to hedge an upcoming or existing position, while others create unique places with erratic benefits. Such advantages are typically unavailable to regular traders. For example, as an options trader, you can profit if the underlying stock remains unchanged. Choosing the right option, or even a combination of options, is a critical success factor in options trading. These are options that are required for the development of a position with the appropriate risk to reward ratio. To be successful and amass significant wealth, you must be an astute trader. To find sophisticated data sets that will earn you attractive rewards, you must go to the options market. Trading options in the previous era. Options price reports were sent to newspapers about a decade ago. The newspapers would list a large number of data rows. The majority of the data was illegible, and most people were unable to decipher its meaning. Such information was frequently published in the financial section of newspapers. Today, however, traders prefer to find options data through online sources. Even if each source formats its data differently, the data and variables used are those that today's traders consider to be essential. Options for today's table. The table below displays IBM's call options for March. Optionetics Platinum software provided the table, which is a computer-generated representation of the data. First, we'll look at the variables listed. If you can read the table above, you'll be well on your way to understanding stock options and increasing your chances of making a lot of money. The columns run down and the rows cross. So let us take a close look at the columns. OPSIM. It's the first column down. In this case, the field indicates the underlying stock, which is IBM. It also displays the strike price, 110,115, 120, contract month and year, and whether the option is a call or put. Either C or P. Make a bid, PTS. The bid price is the price offered explicitly by a market maker to purchase a specific option. As a result, if you place a market order to sell the call, you will sell it at the indicated bid price. Inquire, PTS. The asking price is the most recent price introduced by a market maker to sell an option. As a result, when you trade options on an options exchange, you always get the asking price when you place a market order. When you buy votes at the bid price or sell options at the asking price, you earn money for market makers. As a result, it is advised that a trader consider the bid and asking price just before trading. Active options, on the other hand, have tighter bid and ask spreads than less active options. The bid or ask extrinsic bid or ask PTS. This column displays the amount of time premium injected into the option price. However, you should keep in mind that all options eventually lose their time premium when the option expires. As a result, the extrinsic bid or ask price indicates an option's total time value. Bid or ask delta. Percent delta is the result of a different pricing model. It represents the stock equivalent position of an option. Delta values for call options typically range from 0 to 100, while delta values for put options usually range from 0 to 100. Bid or ask gamma. Percent. Gamma, like delta, is a Greek value. This value is derived in the same way from yet another option pricing model. It informs you of the number of deltas an option stands to lose or gain if the underlying stock rises by a single point. Vega bid or ask, in points or percentage IV. The Vega value represents the amount of expected rise or fall in an option's price. This rise and fall would be based on a single point increase in the volatility of the stock. As a result, as a trader, you should look to buy options when the IV or implied volatility is low and sell options when the IV or implied volatility is high. You will pay a lower time premium this way. Volume. This column simply shows the number of contracts that were traded for a specific option. Bids and request spreads are often tighter with large volumes, but not always. Price of strike. The strike price of an option is generally when a buyer of the option receives payment for the underlying security. As a result, if a trader wishes to exercise their right to purchase the security, they should keep an eye out for the strike price. Important points to remember. The preceding information relates to call options. A put options table would be very similar to the one above, with a few exceptions. You should be aware of these distinctions so that you can put them to use. Options on call. When the strike price is lower, call options are more expensive. Put options, on the other hand, are more costly if the strike price is higher. Call options will have the best or highest prices with the lowest strike prices. This is also true for put options with low strike prices and a higher strike level. The reason for this is that every strike price is either more out of the money or less in the money. It is inverse with put options because as strike prices rise, they become more money or less out of the money. Delta values. Again, with call options, delta values increase and are positive at the low strike price. When it comes to put options, however, delta values rise with higher strike prices and are harmful. As a result, when you buy a put option, you get a negative delta value because it resembles a short position. Profit from option spreading. Option spreading is one of the most common ways to make money with options. Typically, this process entails the simultaneous purchase and sale of options. This is where the term spreading comes into play. The purchase of option combinations is also referred to as option spreading. It is critical to understand this concept because it is one of the most essential strategies for earning a lot of money on a consistent basis. Let's take a close look at the spreading options. Extended put options and long call option. Several alternative positions are frequently used. Most basic is either a long put or a long call on its own. You stand to gain significantly from this position if the underlying asset's price remains stable and the downside is limited to the premium. A straddle is formed when you buy put options with the same strike price and expiration date at the same time. If the cost of the underlying asset rises or falls, you will profit handsomely. The only issue is that you will lose money if the price remains relatively stable. Strangling is another strategy we use. It is a strategy in which a call option is purchased, followed by a put option with a lower strike. The strangle strategy gets its name from this put with a more downward strike. A significant price movement in either direction is required for this strategy to be successful. When you use the strangle or straddle strategies, you will make good money in a market with little movement. Being short means hoping that the asset's price remains in a range for the duration of the expiration period. Being long on calls and short on puts is a strategy that most short-term traders find perplexing. This strategy, also known as a bull put spread, is used when you expect the underlying asset to rise while also expecting to maximize your profits by being short on put options. The two components of this strategy are: 1. Buying calls with a strike price lower than the current stock price, and 2. Writing a contract with a strike price higher than the current stock price but still lower than your premium. Butterflies and bulls are among the available options. Other trading strategies are also essential for successful traders. These two have a lot of potential and will help you make a lot of money. These will essentially demonstrate how to work with specific spreads. For example, we can create a call or put spread, spread the word. This is also referred to as a vertical bear spread. When dealing with this option type, you will buy a put option and then sell another put option with a lower strike price, spread on calls. The vertical bull spread is another name for this type of spread. You can create the spread option by purchasing a call option and simultaneously selling a call option with a higher strike price. When the underlying asset price rises, you can profit from this type of trade. Spreadsheet calendar. Calendar spreads are created when you buy and then sell options with different expiration dates. It is also known as a time spread. Butterflies. When there are options at 3 different strikes, we can say we have a butterfly spread. These 3 strikes are equidistant from one another, and the opportunities at these points are all of the same type. It means they are all puts or calls with the same expiration time. We have the option of having a short or long butterfly. When we have a long butterfly case, you should sell the middle strike option and then buy the outside strikes. These are frequently purchased in a 1-to-1 ratio. Simply put, buy one, sell two, and then buy another. This ratio must always be maintained. Otherwise, the situation will not be a butterfly. The two outside strikes we mentioned are commonly referred to as the butterfly's wings, while the inside is referred to as the body. One important thing to remember is that the butterfly's value will never be zero. Example of a butterfly spread. Let's take a look at an example using the butterfly spread option. We will go long on a 70 call option, then too short at 75, and then long again on an 80 call option. As a result, for our identical trade, we could select the too short 75 puts, the long 70 put, and the 80 put options. Because the butterfly formation is long, it will most likely benefit from a quiet market. We can create a synthetic position directly from the options in the spread example. This type of strategy is also known as put-call parity. To put it simply, the call price minus the put price equals the underlying price minus the strike price. We can create a synthetic long call using the above-mentioned formula. It's as simple as rearranging it. Synthetic puts are simply a long call and a short with the underlying security. There are numerous methods for combining various spreads with trades in the underlying stocks. By doing so, you will be able to achieve a variety of novel positions such as risk reversal, fence, and even collar. You can earn money in a variety of ways with these. Chapter 12. The risk of investing or not investing. No matter how many safeguards you put in place with your trading, there will be some risks, and if you are working with swing trading, you will find that there are even more risks with this type of trading than with some of the other options due to the shorter time frame for trading. Effective risk management can make a significant difference in the success of all of your trades. There are 4 major things you can do to help limit your risks and protect your capital. And they are as follows. Learn how to properly assess the risk and reward of each trade. Set your stoppages and goals. Control the dollar amount of each trade. Keep a journal of all of your trading activities to help you measure your performance and figure out how to improve it in the future. Considering the risk and reward of each trade, the first thing you should think about with each of your trades is how to manage your risk. The goal here is to profit in the stock market, not to buy and sell stocks. If you go into the market and buy and sell stocks at random without considering how you will do so, your broker is the only one who benefits. As a trader, you must learn how to manage both your risk and your account. When you click on the buy or sell button, you are exposing your money to the risk of loss. Figuring out how to limit this slightly can make a significant difference in how much you can earn. An unsuccessful trader will most likely consider an entry, and then only consider their profit on that trade. A successful trader, on the other hand, will always consider both the upside and downside of any business. Furthermore, they will consider how much risk they will face if they suffer a loss. It all boils down to weighing the risk of the trade against the potential reward. To assist you in obtaining a good trade setup, you should expect to receive at least twice the reward when compared to the risk you intend to take. If you can raise this number, the prize will be even more fantastic. If you use this strategy in your trading, you will discover that you can succeed even if you make a few mistakes. Choosing your stops and goals. Now that we have a better understanding of the concept of risk to reward, we must consider how to put it all into action. The stop loss is critical no matter what type of trading you do, but it is essential when you are swing trading and want to protect your capital. As a successful trader or someone aspiring to be successful, you should consider this stop loss to be your best friend. Any trading system or strategy will lose money at some point. A successful trader will keep these losses and be able to walk away from a trade that did not turn a profit. Once you have completed a thorough assessment of the business and determined that the potential reward is at least twice as great as the risks, you will press the appropriate buttons to complete the transaction. Once the trade is initiated, your capital is at risk, and the best way to protect it is to set a stop loss price. This stop point will be the price level at which you determine that the trade is going against your predictions and you don't want to lose too much money. The location of this stop loss will be determined by the trading strategy you choose, but it will essentially allow you to accept a slight loss rather than the potential significant loss that could occur. Stop. Loss orders are an excellent way to keep your ego and emotions out of the game. As a trader, you must learn to accept that the market is correct, even if it contradicts your predictions. You cannot control the market. All you can do is predict where it will go. If you're sitting there rationalizing the trade or looking for some reason why the market isn't moving the way you want it to, emotions have taken over and you're in trouble. Control the trade side. The next step is to manage and control how much of your available capital you will invest in one particular trade. Even if you have great strategy and a lot of planning, there will be times when you have winning trades and times when you will have losing trades and times when you will have losing trades. It is for this reason that it is critical never to overcommit your capital on a single business, or you will work yourself out of the market. Many experienced traders will use a rule of thumb that says you should not risk more than 2% of your capital on a single trade. For example, if you deposit $20,000 into your account, you should not risk more than $400 on a single transaction. Keeping a trading journal. You can do this online or by keeping a paper copy close at hand. When you finish a trade, make a note of what happened, what strategy you used, what was going on in the market, how much you spent, and so on. Many people prefer to skip this step but can come in handy later on. The more details you can add, the better it will be. If you ever get stuck with one of your trades or are unsure how to handle a particular situation, you can refer back to this journal for guidance. You might be surprised to learn that after a challenging situation in another trade, you can look back in this journal and find the answers you require. Chapter 13. Answers to frequently asked option trading question. What are put options and how do they work? Put options. Contracts can be purchased through a company in increments of 100 offers. Non-standard options vary from the 100 edition on a regular basis. Assume you believe that shares of ABC Innovation Organization will depreciate in a quarter of a year from the $100 an offer they are currently trading at. A put option grants you the right to sell at your strike price of $100 within 3 months, regardless of whether the offer price falls below that amount. If you exercise your put option when the stock falls to $90, your profit is $10 per share multiplied by 100 offers, or $1,000. If your options contract charges a premium of $2 per offer, you must deduct $200, $2 multiplied by 100 bids, from your benefit, bringing it to $800 less any commissions charged by your financier. Expert advice. When the price of your hidden stock falls below a certain threshold, you can recoup your initial investment. The strike price less the price you paid. It is profitable, barring commissions. However, if the stock's value rises, your put options may become ineffective, and there is no reason to practice them. In this case, you will incur a loss because you will be out of the $200 premium you paid for the put options contract. The proceeding is referred to as a long put methodology. Put options, like call options, have straightforward procedures, and it is entirely expected that you will consolidate them with call options, various put options, and value positions that you currently hold. Some of the more common systems are stripped puts, secured puts, put spreads, and defensive puts. A defensive put, also known as a wedded put, provides you with options to protect the assets you own from value declines. What role do you play? You keep clinging to your offers while also holding put options, which can be viewed as a hedge against value decay. What happens if the stock's cost per offer rises? Accept a similar rise in tech stock prices of $90 per share. That is $20 per share. That is $20 per share more than your strike price, so you'd have no desire to practice your put option. You'd just let it lapse. However, because you purchased the options contract, you will forfeit the $300 premium paid. $1 per offer multiplied by 300 offers. Instead, you will sell your stock, resulting in a $4,200 profit. $15 borne by 300 bids, minus the top-tier cost of $300. Because the potential growth is limitless, the potential benefit of a secured put is also unlimited, minus the premium paid. What are the differences between covered and naked puts? When you're the dealer, naked and covered, puts become crucial. A put is considered secure if you also short the same number of shares in the underlying security. Shorting a fundamental stock is when you receive offers and immediately sell them, believing that you will be able to obtain them again at a lower cost later. Expert advice. A secured put is a system to consider if you believe the price of a stock will fall. However, if you believe a stock's price will remain unchanged or rise, you may want to consider an exposed put alternative, also known as a revealed put or short put. You do not short portions of the hidden stock when using a naked put. The fundamental protections will be at the strike price if you obtain them with a naked put. Here's how a trimmed put works. Remember the ABC Tech organization. Assume you believe the stock will remain level or rise, so you sell a naked put option with a strike price of $90. In exchange for agreeing to buy 100 shares of XYZ at $90, you get a premium option of $1 per offer or $100 if XUZ falls below the strike price. If, on the other hand, the offer price exceeds the strike price of $90 share and the option expires, you keep the option's premium and are relieved of your commitment. Brilliant idea. Because the primary goal of naked put options trading is to collect the option's premium as salary, you should avoid using this technique if you believe the stock's price is declining. It's a different story if the introductory stock price falls below $90. In theory, the cost could then be reduced to zero, and you would be committed to purchasing 100 portions of XIZZ at the strike price of $90. Put options and short selling are compared. Purchasing puts is similar to short selling in that you are betting against a stock, but they are not the same type of transaction. Some investors prefer trading options because they do not require security, as they do with short deals. Furthermore, the disadvantage of put options is limited to the amount spent on the agreement. Keep in mind that if you buy a put option, you have the right, but not the obligation to sell the stock. So even if they make a mistake and the stock rises, they will only lose the premium. Although your losses may continue to mount until you purchase the stock to close the position, short selling is diverse. Risks involved with put options. As previously stated, put options can be used to increase your profit during a down market, or even during a single securities downturn. In any case, options trading is not suitable for inexperienced investors. Of course, it can provide adaptability, opportunities, and a degree of risk reduction. However, options trading is not without risk. Investors should first understand the intricate details of options trading before jumping in, whether they are self-coordinated or do it on their own. Time decay is one of the risks. Every day, time rots your estimation of your options. Finally, the closer your agreement gets to its expiration date, the less time there is for the security to move one way or the other. Brilliant idea. One method for reducing time rot is to use more extended option contracts of 3 to 5 years in length, or to sell your agreement as the expiration date approaches. Another risk is suggested instability, which indicates how volatile the market may become in the future. Assume you're attempting to make sense of the possibility of a stock reaching a specific price by a particular time. In that case, suggested volatility can allow you to enter an options trade with full knowledge of the market's emotions. Volatility. It is the sum of stocks' price changes is another type of risk. While some fear a market decline, bearish investors can use put options to profit from declining value moves. They are not without risk, but they can act as a silver lining in a sagging financial market. Conclusion. Keep in mind that risk management is critical. Stick to your per-trade risk figures and don't stray from them, no matter how appealing the setup appears. Remember that the chances of success are the same for a slam-dunk-looking structure and one that looks like a dog's dinner. The market isn't concerned with how attractive your setup is, and you shouldn't be either. If the underlying conditions are met, your form should be executed correctly. Always begin your analysis with the technical market situation, order flow distribution, and trend or range situation. Frequently, you will be dealing with trends that have nearly equal participation from both sides of the market. It should alert you to the fact that a reversal is likely, and you should adjust accordingly. Support and resistance will be essential factors in determining where to place your strike prices. Remember to evaluate support and resistance levels in terms of order flow rather than looking at every available group on the chart. Instead, consider how the preceding time price's order flow characteristics got there and compare them to the current order flow to get a sense of whether the level will hold or not. Screening stocks is a simple process if you follow the steps outlined here. To begin, compare sector performance to overall market performance to determine which sectors to focus on. After that, repeat the process with individual stocks to select the best to speculate on. Training and making a loss, or training and making a profit. It is entirely up to you to make that decision. However, I can assure you that having a mentor will save you money and result in a successful outcome. Now that you've armed yourself with the necessary knowledge, it's time to embark on your journey into options trading. It is a good investment with the potential for a positive outcome. What are you waiting for to start investing now that you know what it entails? Its pros and cons, option strategies, and success tips. As you begin your career as an options trader, you should be in the process of opening a brokerage account. It is currently the most excellent investment in which to begin trading. Life is full of opportunities, and options trading is just one of them. If you want to make an investment that will completely change your life, this is it. It is a convenient, dependable, and fantastic way to earn money. Some people have made it a full-time job. They have identified it as an investment on which they can rely for a positive outcome. If you are new to option trading, this is an excellent investment to make. The trick is to master the strategies that will maximize your returns while minimizing your risks. After all, the entire purpose of investing is to make money. There are many different types of investments available to you to work with. Some will take over real estate and rent it out or sell it to someone else. Some will start their own businesses in order to make money. Others will invest in the stock market, hoping to make the right decisions. However, one investment that stands out from the rest is options trading. This guidebook has spent some time discussing options trading and all of the cool things you can do with it. First, we discussed options and some of the advantages of working with them. When it comes to options trading, there is some risk involved, just like with any other type of investment. The good news is that we discussed the most common blunders to avoid and how to reduce the amount of risk you take on within this investment opportunity. Options investing is a complex investment to choose, but it provides a high return on investment and is often easier to get into than the stock market. To summarize your market approach, it is a good idea to put all of this into a trading plan. Consider it your trading business plan for success. List your trading instrument strategies and how you intend to expand on them. In terms of trading options, the topics covered here only scratch the surface. There are numerous other strategies to consider. Your next step would be to study the Greeks and apply them to your plan. I'm not referring to the Iliad, but rather the delta, theta, omega, alpha, and beta. In addition, you can learn about ratio backspreads and butterfly trades. All of this may sound exotic, but it is highly effective. However, before proceeding, you should thoroughly understand the material presented here. The most difficult adjustment for most traders is to the non-directional nature of options. Understanding a stop loss and taking profit is simple, but dealing with a call option and a short put while in a falling market can be perplexing. You have now progressed from novice to initiated, and you have gained the fundamental knowledge that will allow you to enter the exciting world of options trading. It is far from exhaustive, but it provides a solid foundation for you to get started. It's all about practice and being conservative as you improve your understanding and develop your strategies from here on out. Only you will know what works best for you, how much risk you want to take, and how to best apply your personal ability to predict and determine the stock market. As you get your feet wet, you'll start to see profits roll in, and you'll get that buzz that all options traders get. You're in for a treat when done correctly. Option trading is both rewarding and exciting. Remember to keep that calendar up to date and to be conservative at first, and you'll be able to enjoy the learning curve every step of the way. Do not be disheartened by a single setback. The world's wealthiest traders and investors have all taken hits from which they believed they would never recover. Remember that there will be times when you don't get as much back as you hoped, but there will also be times when you make more money than you did with your initial investment. You have now taken a careful stroll through the essential standards and ventures in options trading that we believe are essential for progress as an options trader. You understand how options markets work, the best trading strategies, and why it is critical to select the best possible fundamental assets for the procedures you need to use. You've also noticed that great exit strategies are nearly as important as finding great trades to enter, and that focusing on the points of interest is essential. That feat is almost impossible to achieve without an excellent money management strategy and the discipline to stick to it. Finally, you have a lot of pages full of important questions to consider in your search for the best online options broker. It's a fantastic opportunity to gain control, plug in, and profit. You have all of the data to appreciate 24 hours a day, 7 days a week. Access to the options markets, fast and automated order execution, and the lowest commissions in the history of options trading in any case. In order to share these benefits, you must first confront the more extensive individual responsibilities that come with coordinated access to online trading. You should have the discipline to conduct your own research, screen your positions, and monitor all of the investments you leave to your full-service financial firm. You can never again rely on a broker to keep an eye on your positions and call you with advice or suggestions. You are currently an autonomous administrator, and you must be entirely in control of your actions. Similarly, you should be aware of and ready to react to rapid changes in any trading strategy as well as constantly changing longer-term economic situations. Thank you for sticking with me all the way to the end. I hope you found this article to be informative and educational. Options are a great way to get started in the stock market with a lot less money up front. They can, however, be tricky because they have expiration dates, which means you must get in and out at the right time and cannot wait things out like you can with stocks. When you make profitable trades, the return on investment is far superior to stocks, so be sure to thoroughly research the securities in which you are investing to determine where the stock has the most potential to move. Also, continue to learn, and I hope this was a good start.